Hello, it's a pretty lovely good evening once again from here in Delhi, and hope as always that each one of you are absolutely fine. But somewhere, I know inside of your heart actually each one of you are having a bit of worry. So course is so lengthy and examinations are approaching so fast, so how we are going to actually manage all these things, how we are going to actually retain the things. But you need not require to worry on that particular count, as I told you, and I promised to you too, that I'm going to give you a very quick fire, ultra ballistic revision. Now, this ultra ballistic revision, which I'm going to provide you, will surely, after having gone through this revision series, each one of you are going to find yourself pretty relaxed, and I'm sure each one of you would like that. So, we are going to start this revision series for corporate accounts. And we are going to start with redemption of preference shares. Now, for that, I'm going to taking you to my regular classes. Now, just pay attention. When I started off this particular chapter, the first point which I stressed upon was with respect to what we call that Section 55 of the Companies Act 2013 governs the provisions of the redemption of preference share capital. This is vital for your objective type question also. I also told you with the maximum period of redemption is 20 years, no doubt about that. Suppose if a company is going to actually issue the preference share today, then within next 20 years, it will have to redeem. However, if the preference shares are meant for what we call infrastructural projects, in that particular case, the maximum redemption period could be 30 years. So these are the points which we talked a lot, what we call in our regular class. I hope actually now it is getting reminded to you. Now, the main problem as far as accounting is concerned in this particular case is that, as you know, when a company is going to redeem the preference share capital, if you remember, I talked about this particular fact that our capital base actually gets altered. Now, if the capital base, now first of all, you need to understand what we mean by capital base. There is lots of difference between capital employed and capital base. Capital base comprises of only equity share capital, preference share capital, and capital redemption reserve. Is it clear to you? So quite obviously, if the company is going to redeem preference share capital, its capital base will get altered. And if you remember, I also talked about the fact that no company can afford any changes in the capital base because it sends wrong signals regarding the image of the company. So that is the reason actually it becomes paramount and imperative for the company to restore the capital base as quickly as possible. Now, in order to restore the capital base, if you remember, actually we talked about this particular fact that company actually goes for utilization of reserves, and company goes for fresh issue. If utilization of reserves are not sufficient, then company will go for fresh issue also. Is it clear to you? This is the point which we talked about. When we say utilization of reserve, it means actually transfer to capital redemption reserve. So, we will take into account the nominal value of the preference share capital which the company is willing to redeem. And we know that when the company will redeem the what we call preference share capital, its capital base will get altered and we will have to restore it. And in order to restore the capital base, actually we go for utilization reserves and fresh issue. Importantly, I also talked about this particular fact that in order to restore the capital base, company utilizes revenue nature reserves only. That means you cannot actually utilize the capital nature reserves. Revenue nature reserves are general reserve, reserve fund, profit and loss account, correct workman compensation fund, sinking fund, etc., insurance fund, IF. However, if you are not having the sufficient balance in the what we call revenue reserves, then you are going to make the deficiency good by going through a fresh issue. However, you need to actually keep in your mind when you are going to make the fresh issue, you will have to take into account only the nominal value of the fresh issue for the purpose of restoration of preference share capital working. Is it clear to you or not? These are the vital points. Another important point. Sometime in the question, fresh issue is given in absolute terms. If you remember, I also talked about this particular point. If fresh issue is given in absolute point, in that case, first of all, you are going to consider the nominal value of the fresh issue, and then you are going to actually take the balance out of the revenue reserves. If fresh issue is given in absolute terms in the question. Otherwise, first of all, we are going to utilize the revenue reserves, and then we will go for fresh issue. However, if fresh issue is given in absolute terms, in that particular case, fresh issue will be considered first. This is first point. Another important point is that sometime it was given in the question that preference shares are redeemable at a premium. Now, regarding that, there is many confusion. And I talked at great length that you have to now as per Companies Act 2013, you have to write it off against profit and loss account, in spite of the fact that in many books and even in your module, it is premium on redemption of preference share capital has been written off out of security premium. But this is wrong. Is it clear to you? So now the policy should be to write off what we call security premium out of profit and loss account. And in order to play safe, you also write a note actually that company is following the accounting standards. Is it clear to you? If company follows accounting standard, then it is paramount importance that company must write off the what we call premium on redemption of preference share capital out of profit and loss account. Is it clear to you? And it is quite natural that quite every corporate entities nowadays actually follow standards. So these are the important point as far as this particular chapter is concerned. But just to make you a little bit more comfortable actually, just pay attention here. Now suppose my company is redeeming 5 lakh worth of preference share capital. Suppose my company is redeeming 5 lakh worth of preference share capital. Is it clear to you? So first of all, and only this much information is given in the question that company is going to redeem its preference share capital, and we presume that preference share capital is 5 lakh worth. Now, first of all, I will look into the balance sheet. I will try to trace out by revenue nature reserves. Let us say there is a balance in general reserve 4 lakh. There is some balance in profit or loss account also. So I need only 5 lakh. So in this case, there is sufficient balance. I need not require to go for the fresh issue. As I also told you, as far as entries are concerned, first of all, you are going to pass the entry for the amount due. Entry will be preference share capital account debit to preference shareholder. This is your what we call due entry. Then you are going to pass the entry as per your working. You have utilized general reserve and profit or loss account, and then you are going to transfer it to capital redemption reserve. And then finally, actually, you are going to make the actual payment. Simple. Now, another case. Let us say in this case, company is actually supposed to redeem. This is another case. Let us say company is supposed to redeem the 5 lakh worth of preference share capital. Is it clear to you? Now you saw actually that in the last question we have sufficient balance in the revenue reserve. We needed 5 lakh and there was a balance worth rupees 5 lakh in the balance sheet presumed. But let us say in this case in the balance sheet there is general reserve to the extent of 2 lakh and profit and loss account to the extent of 1 lakh only. So I need 5 lakh, but there is a balance of only 3 lakh. So there is a deficiency in this particular case. So what I need to do now, I will have to actually go for the fresh issue. So in this case, fresh issue will be 2 lakh. So in this case, pattern of your entry would unfold in this manner. First of all, you are going to pass the due entry, preference share capital to preference shareholder. You will look into your working. You have utilized general reserve, profit and loss account. You transfer them to what we call general reserve. But this time, you have also done a fresh issue. So your entry will be bank account debit to preference share capital. And finally, you are going to make the actual payment. So this is how you are supposed to do. Another important point. Let us say, I am supposed to redeem 5 lakh worth of preference share capital. It is always better, first of all, somewhere you do the workings or analysis. Amount of preference share capital to be redeemed, nominal value 5 lakh. Is it clear to you? But suppose in the question it is given that you have sold some asset. And if you remember in my regular classes, I talked a lot about this particular point, that if any information is there with respect to sale of an asset, immediately don't go for the working. First of all, you pass the due entry that you are supposed to redeem 5 lakh worth of preference share capital. This is your due entry. Now, if there is some information with respect to sale of an asset, for example, in this particular question, let us say investment in the balance sheet is 2 lakh. And suppose it is given that you sold it for rupees 1,50,000, your entry will be bank account debit, profit and loss account debit. So that means you have incurred a loss. That means if there is some information with respect to what we call sale of an asset, in that particular case, first of all, you must pass due entry and then you pass the entry for the sale of asset and then you move over to the working part. Now I will move over to the working part. I am supposed to redeem 5 lakh worth of preference share capital. General reserve balance is, let us say, 1 lakh. And profit or loss account balance in the balance sheet was 2 lakh, but because there is a loss due to sale of an asset, now the balance will be equal to 1 lakh 50. So total balance in reserves is equal to 2 lakh 50. So I still need 250, which I will need what we call true issue of what we call fresh issue. So in this case, my pattern of entry will be like this. Now my third entry will be for utilization of reserve, and my fourth entry will be for fresh issue, and finally I am going to pass the entry for the actual payment, and you can prepare the balance sheet accordingly also. Last important point in this particular chapter. If preference share capital are to be redeemed, let us say at a premium. Let us say I am supposed to redeem 5 lakh worth of preference share capital at a premium of 50,000, 10% premium. So total actual payment obviously will be 5 lakh 50,000. Number one. Number two, I will go for what we call utilization or reserve. But presume in this particular question, it is given in the question that company has made a fresh issue of equity shares to the tune of rupees 3 lakh. So because in this case, fresh issue is given in absolute terms, so I will first of all consider fresh issue. Let us say fresh issue is 3 lakh. So I will need only now 2 lakh because nominal value of the preference share capital is 5 lakh, isn't it or not? Another important point. In the balance sheet, let us say profit or loss account balance is equal to 2 lakh. Is it clear to you? And in this question, let us say, first of all, my first entry will be preference share capital account debit 5 lakh because question states that we are supposed to redeem the preference share capital at a premium. So I'm going to actually here write premium on redemption to preference shareholder account. This is our liability. I have to make the payment for this later on. Let us say in this particular question, I told you, in fact, whenever there is a case of premium on redemption, you must write it off against the P&L. It has become imperative as per Companies Act 2013 on the presumption that company follows accounting standard. Is it clear to you? So you will debit the premium on redemption because it is a capital loss. So, however, it is a capital loss. Logically, people say that it must be written off against the security premium. But now, as I told you, company which follow accounting standard must provide premium on redemption. It means must write off premium on redemption out of profit or loss account as per Companies Act 2013. That is the reason actually you will consider it as written off against profit or loss account. This is the entry you are going to pass. Here I have written a note also. Premium on redemption is a capital loss. However, as per Companies Act guidelines, companies that follow accounting standard must provide for premium or redemption out of profit or loss account or general reserve. Is it clear to you? In this question, there was another information with respect to sale of an asset. Let us say 2 lakh worth of investment were sold for 1,50,000. So there will be a loss of what we call 50,000 also. So you must have seen that there was a balance in profit or loss account 2 lakh, but we used 50,000 for writing of security premium and there is a loss on sale of investment. So net balance is 1 lakh. So in this particular case, you have general reserve balance 1 lakh and you can utilize only 1 lakh out of profit or loss account. Although you needed only 2 lakh because 3 lakh is the fresh issue which is given in the absolute terms. So I will consider fresh issue first and then I am going to what we call consider the what we call reserves. Is it clear to you? So my pattern of entries will be like this. Whenever the question is stated that preference share capital should be redeemed at a premium, first of all, you must write the due entry, then write off the what we call premium against the P&L account, and then pass the entry for sale of asset, and then you look into the working. Now, in this case, because fresh issue was given first, so that is the reason I am passing the entry for fresh issue first, and then I am passing the entry for utilization of reserve. Finally, I am going to make the payment. Is it clear to you? These are the points which we are supposed to follow as far as redemption of preference share capital is concerned. Is it clear to you or not? Now, coming over to this particular question, this particular chapter, which are the important questions? As I told you, your first part is very important, and second one is where the questions are redeemed, questions related to premium or redemption at a premium. You do any one question that is suffice for to completely what we call this particular chapter. These are the major points, and what possible MCQs could be framed. I talked about that particular point also. Is it clear to you or not? So after having done this, now we will go for the buyback of share. If you remember in the class, we talked a lot about buyback of share because both are absolutely same. As far as theme is concerned, both are absolutely same. Important point is from objective type of questions. Objective type. First of all, you need to understand that buyback of shares are basically covered by section 68, 69 and 70 of the Companies Act. Is it clear to you? Number one. Very important, which many people do not know, that provisions of Companies Act applies to unlisted companies. Actually, at your level, you will always presume the company which is given to you is an unlisted company. Is it clear to you? That means you will have to apply the provisions of the Companies Act. But just for your knowledge, that such companies which are listed, in that particular case, SEBI's guideline apply. Is it clear to you or not? But at your level, you have only case of unlisted company, because it will never be given to you that this is a listed company or unlisted company. You will always presume unlisted company and you will apply the rules of the what we call unlisted company. I told you what we mean by buyback of share. Buyback of shares simply means repurchase of shares by a company. Similar to Similar to preference share capital. When a company is going to buy back its own equity share, indirectly it means company is redeeming its preference share capital, although we never use the word redemption of equity share. We always call it what we call buyback of share. Is it clear to you? Number one. Number two. Because we are indirectly redeeming our equity share capital through buyback, again it is going to change my capital reserve, my capital base. Capital base, I just told you, comprises of equity share capital, preference share capital, and capital redemption reserve. Is it clear to you? Logic is same. Altered capital base is not viewed positively in the capital market, as I told you. So therefore it must be restored. In order to restore, as I told you earlier, company is going to utilize its revenue reserve, company is going to make a fresh issue. Rules are absolutely same, but only difference is that in case of buyback of shares, suppose company is going to actually buy back the equity share or redeem the equity share at a premium. In this case, you are allowed to write off premium against a security premium. In case of buyback of share, the premium on redemption can be written off against the security premium. This is the major area which you need to take care of. Is it clear to you or not? Just to make the point clear, suppose this is the balance sheet. This is a demonstration question. Let us say this is the balance sheet as on T1, as on 31st/3/2027 of T1 Limited. Let us say equity share capital, we are being given 5,000 10% preference shares of 100 each, that is equal to 5 lakh. Further, we are also given 10,000 equity shares of 100 each, 10 lakhs. So preference share capital and equity share capital is given to us. And we have been given here general reserve, profit or loss account, capital reserve. 50,000, 1 lakh and 2 lakh. You must understand that out of these three reserve, revenue reserves are general reserve and profit or loss account, and capital reserve is a capital nature reserve. Further, it is given director decide to buy back 25% of its equity share capital. Another important point from the MCQ point of view, maximum redemption of equity share capital could be 25%. I'm intentionally using the word redemption, although we should never use it. In case of what we call equity share, company always buy back the shares. Indirectly, it means redemption of equity share. So first of all, as I told you in my regular classes, how you are going to proceed. Always note down carefully the number of equity shares. Number of equity shares is 10,000, correct? And buyback is what we call 25%. Is it clear to you? So 2,500 equity shares you are buying back. Obviously, when you are going to buy back, your capital base will reduce or get changed. So restoration of capital base. For that, again, you will consider the nominal value of equity share capital being bought back. So 2,500 into 100, that is equal to 2,50,000. Is it clear to you? You are going to utilize the reserve. General reserve in this question is there. Profit and loss account is given. You cannot utilize what we call capital nature reserves. Is it clear to you or not? So we have sufficient reserves. So I need not require to go for any fresh issue. So my entry will be like this. First of all, I am going to write due entry. Similar to preference share capital, I will write equity share capital to equity shareholder. You can also write equity share buyback account also. Many people, instead of writing equity shareholders, they write equity share buyback account. Both are synonymously used. Is it clear? Then you will have to pass the entry for utilization of reserves, that is general reserve P&L account debit to CRR. Then you are going to make what we call fresh issue, because in this particular question we haven't made any fresh issue. Actually we have made a fresh issue of 1 lakh. I'm sorry, because we are supposed to buy back equity share to the extent of nominal value of 250, but we have only what we call reserves to the extent of 150. I'm extremely sorry. So fresh issue will be done. So you will pass the entry for fresh issue also, bank account debit to 10% preference share. Then finally you are going to pass this particular entry. Is it clear to you? Now under second case, I'm trying to recap the entire chapter. Just try to pay attention. Share capital, preference share capital 5 lakh is given, equity share capital once again. General reserve 50,000, profit or loss account 1 lakh. You are being given capital reserve and statutory reserve. Capital reserve, statutory reserves you cannot use for the purpose of buyback. You can use only revenue nature reserves, that is general reserve and profit or loss account. Director decide to buy back 25% worth of equity share capital at par, and for the same decided to sell the investment, book value 5 lakh at 4 lakh 50. Similar to the redemption of preference share capital, because there is some information with respect to sale of an asset. In this particular case, immediately instead of going for the working, first of all you are going to pass the entry for the amount due. The entry for the amount due will be equity share capital nominal value 2 lakh 50 and 2 equity shareholder or 2 equity share buyback, whatever you want to write. Is it clear to you? So 2 lakh 50 worth of equity share capital you are supposed to actually buy back. Another important point in this particular question, because you are selling the investment worth rupees 5 lakh for 4 lakh 50, so your profit will get reduced by 50,000. Now you go for the working. After incorporating the entry for sale of asset, then only you go for the working. Is it clear to you? When you are going to go for the working, where I have done the working for this particular question. Okay, no problem. Let us say 2,50,000 is my nominal value. Just wait. 2,50,000 is nominal value. Now I will look into the what we call reserves. Is it clear to you? Now what is the position of the reserve? Because general reserve was 50,000, I will write 50,000. I will take into account profit and loss account. Let me check. Balance in profit and loss account as per balance sheet is actually 1 lakh. But because we have passed the entry for sale of an asset and thereon we incurred a loss of rupees 50,000, I will have to subtract 50,000. That means I can utilize only 50,000 from profit and loss account. So this time my fresh issue will be equal to 1 lakh 50. Utilization of reserves will be equal to 1 lakh and 1 lakh 50,000 will be fresh issue. Is it clear to you or not? Right, sir. So if it is clear to you, then just allow me. So if it is clear to you, just a second. Just a second. So now, you are going to pass the entry general reserve which you have utilized to the extent of 50, then profit and loss account 50,000 to CRR account. Is it clear to you? Then because you have made a fresh issue entry, you are going to pass. And finally, you are going to make the actual payment entry, equity shareholder account debit to bank account. And just to recap once again, your revenue nature reserves list: general reserve, P&L reserve fund, workman compensation fund, insurance fund, dividend equalization fund. Capital nature reserves are security premium, capital reserve, revaluation reserve, capital redemption reserve. And under statutory reserves, generally we include investment allowance reserve, development rebate reserve, foreign project reserve account. Is it clear to you or not? So now let us say, just wait. This was demo 3. Where is demo 3 I have done? I want to recap entire portion. Demo 3. Okay, we pick up demo 4, no problem. Here it is given that equity share capital 50,000 into 150 lakh. And in this particular question, let us say general reserve is given to you as rupees 3 lakh, profit or loss account 5 lakh. They are your revenue nature reserves. Security premium is your capital nature reserve. Besides that, we are being given non-current liability and current liability, and asset side we are being given property, plant and equipment tangible, then non-current investment to the tune of 10 lakh and cash at bank is equal to 8 lakh. And below some information is given that company went for buyback of 25% of the share capital at a premium of 20%. I told you in case of premium on redemption of preference share capital, the premium on redemption must be written off out of profit or loss account. But in case of buyback of share, you can write it off against capital nature reserves, that is security premium. Is it clear to you? This is the only difference. Also, it was decided to sell the investment for rupees 9 lakh. So to make the process simple actually, just here, total number of shares given in the balance sheet 50,000. We are redeeming 25%. That means total number of shares which we are supposed to redeem is equal to 12,500. Number one. Number two, nominal value 12,500 into 100, 12 lakh 50,000. So my capital base will fall down by 12 lakh 50,000. Now I will have to go for what we call working now. Before I start the working actually, as you can see in this particular question, we are being given that we are doing the buyback at 20% premium. So my entry will be equity share capital nominal value this much 12 lakh 50, but premium on buyback, we write premium on buyback 2 lakh 50,000, 20% of 12 lakh 50. To equity shareholder or equity share buyback account, you can use it in the examination also, ESBB, equity share buyback account 15 lakh. This is your due entry. First of all, immediately write off premium on buyback. As I told you, premium on buyback, in case of buyback of share, must first be written off against security premium, because you have in this case security premium to the extent of 5 lakh. to the extent of 5 lakh, whereas premium on redemption is 2 lakh 50. So you have sufficient balance in security premium 2 lakh 50. So you will write security premium account 2 lakh 50 to premium on buyback. However, suppose consider balance in security premium would have been only 2 lakh. In that case, you could have had utilized any other revenue reserve. For instance, in this case, suppose security premium balance is only 2 lakh, then I would have taken 50,000 from profit or loss account or general reserve. Is it clear to you? That means in case of buyback of shares, you can write off the what we call premium against security premium and also against the what we call revenue nature reserve, but preference must be delivered to security premium. That is the point. So I have written a note also, premium on buyback is a capital loss, thus preferably it should be written off against security premium. However, if security premium balance is not enough, then you can go for revenue nature reserves. Is it clear to you? After passing down these entries, there is an information that investment worth rupees 10 lakh have been sold for rupees 9 lakh. So I will write here 9 lakh bank account, profit or loss account to investment account. Now I will move over to the working. I am supposed to actually restore 12 lakh 50,000. So I will check my balance. Importantly, this is the most important part of this particular chapter. In case of redemption of preference share, as far as utilization of reserve is concerned, you cannot utilize any capital nature reserve. You can use only revenue nature reserves. However, in case of buyback of shares, law says that as far as utilization of reserve is concerned, you can also use surplus balance of security premium. You can also use surplus balance of security premium. Now, what we mean by surplus balance of security premium? Because in this case, security premium was 5 lakh, but out of 5 lakh, I have already utilized 2 lakh 50,000 for the purpose of writing of premium on buyback. So that means there is a surplus balance of 2 lakh 50,000 only. So now I will look into the balance sheet. General reserve is 3 lakh and profit or loss account balance was 5 lakh. But because of loss on sale of investment, it will get reduced by 1 lakh. So the balance in profit or loss account will be 4 lakh. So that means total balance will be equal to 7 lakh, and that comes to 9 lakh 50,000. So I still need 3 lakh, which I will make good by what we call making a fresh issue. And remember one thing, you are going to make a fresh issue in this particular case to the extent of rupees 3 lakh. So your entry will be like this. You have utilized the reserve, security premium, general reserve and profit or loss account. You will transfer them to CRR and fresh issue entry bank account debit to preference share capital account unless and until otherwise stated. In case of buyback of share, fresh issue will be only of preference shares. Whereas in case of redemption of preference share, unless and until otherwise stated, fresh issue will be of equity shares only. These are the areas actually which give concern to the student. That is the reason actually I am elaborating it. And then finally you are going to make the payment for what we call, finally you are going to make the payment, actual payment. So this is how this particular chapter deals up with. I hope that all the provisions have been recapitulated and now you will feel a little bit what we call confident. Coming over to the next part. Next part is rights issue. And before we move over to rights issue, just wait. Along with rights issue, I will also make bonus issue also, correct? So that from bonus issue, you can hardly expect a 2 or 3 marks question, but from rights issue, there will be a question of 4 marks. You can take it from my side. Is it clear to you or not? Well, we come over to the bonus issue. If you remember, in fact, generally, when I start my regular classes, I start with what we call bonus issue. Coming over to the bonus issue, now kindly pay attention over here. Bonus issue. Here it is bonus issue. When I start off this particular chapter, I generally start it by this way around, that issue of bonus share is covered by section 63, quite vital from your MCQ point of view. Is it clear to you? So section 63 actually governs the affair. Then issue of bonus shares by a company to its, what we mean by bonus share? Bonus issue is nothing but issuance of the shares to the existing shareholder without making them to pay for the same. That means we are issuing the shares to the existing shareholder and we are not asking for the what we call cash from the existing shareholder. These shares are offered free. So issue of bonus shares by a company to its existing shareholder free of cost is known as bonus issue. Correct? As such, when an entity makes a bonus issue, quite obviously it means shareholders are not required to pay for the same. When bonus issue is made, now quite obviously if I'm going to issue the shares and I'm not receiving the cash, so question is what entry I am means the company. What entry from the perspective of the company will be done? So your entry will be reserves account debit to share capital, that is equity share capital. Is it clear to you or not? That means for the purpose of bonus issue, company is not asking the cash from the shareholders, rather on their behalf company is utilizing its own reserves. Is it clear to you? Because company is utilizing the reserves, so that means reserves will fall down and we are transferring this amount to share capital. Indirectly, it means our reserves are getting converted into share capital. So that is why bonus issue is also known as capitalization of profits. Again, this is important from the viewpoint of your MCQ. Is it clear to you or not? Bonus issue is also referred to as dividend in kind. Generally, dividend is given in cash, but this time we are giving them some sort of what we call extra benefit, but in the form of shares. You are an existing shareholder of my company and my company is issuing you some shares. So quite obviously it's a benefit to you. But this is in kind and not in cash. That is why bonus issue is also referred to as dividend in kind. Another important point for MCQ. Is it clear to you? Coming over to bonus issue. Now, I told you in my regular classes that bonus issue can be made to fully paid shares and also it can be made to make the partly paid up shares as fully paid. Is it clear? Another important point. When a company is going to make the bonus issue to the fully paid shares, in that case, we can use capital nature reserves and we can use revenue nature reserves also. Is it clear to you or not? We can use capital nature reserves and revenue nature reserves. But another important point, you must understand what are capital nature reserves, security premium, capital reserve, capital redemption reserve, share forfeited balance. All these are capital nature reserve. Bonus to fully paid shares can be made out of capital nature reserves and also out of revenue nature reserves. But preferably, first of all, you are going to use the capital nature reserves. Is it clear to you? Now, as far as revenue nature reserves are concerned, general reserve, P&L reserve fund, insurance fund, workman compensation fund, dividend equalization fund. But very important point, which I talked about this particular chapter. When you are going to utilize the capital nature reserve, it is important that you can utilize only such capital nature reserves which have been realized in cash. And such capital nature reserves which haven't been realized in cash cannot be utilized. Is it clear to you? So these are the points which we covered actually under this particular chapter. But just to make the point further clear, following types of reserves cannot be used: statutory reserves, investment allowance reserve, development rebate reserve, foreign project reserves, and specific reserve. Specific reserves are nothing but provisions, like provision for doubtful debts, provision for depreciation, stock reserve, etc. Is it clear to you or not? So you cannot utilize such reserves. Is it clear to you or not? So just to make the point, now see here. Even though it's a small chapter, as you can see, even though we are taking up the revision, we are trying to actually cover up every facet of the chapter. Balance sheet of F1 Limited as on 31st/3/2027 is given to you. On the equity and liability side, we have been given shareholders fund. Equity share capital 50,000 into 150 lakh. We are being given general reserve, profit and loss account, insurance fund, dividend equalization fund. All these are revenue nature reserves. Correct? And security premium, capital reserve, CRR, all these are capital nature reserves. On this date, directors decided to make a bonus issue in the ratio of 3:5. Isn't it? Now, on this date, director decided to make a bonus issue in the ratio of 3:5. Indirectly, it means this is a case of bonus to fully paid share. Whenever it would be given in the question that bonus issue has been made in the ratio of 1:2, 3:5, 4:5, you always presume that this bonus issue is meant for fully paid shares. Is it clear to you? Now, it is also given that capital reserve includes 3 lakh on account of increase in value of plant and machinery. Now, question says that there is a balance in general reserve to the extent of 5 lakh. But out of this 5 lakh, 3 lakh is on account of increase in value of asset. Now, when value of the asset will increase, quite obviously no cash inflow will come. So indirectly, it means 3 lakh worth of capital reserve is not realized in cash. So you cannot utilize, and balance will be considered as realized in cash. Is it clear to you or not? Also, it is given that security premium includes 3 lakh against shares issued to vendors for purchase of machinery. So indirectly, it means whatever balance is there in the security premium, out of that 3 lakh is not realized in cash, because this premium is on such shares which have been issued against purchase of machinery. We haven't issued these shares to the public. So we did not realize any cash against the same. So that means only 7 lakh can be used. Now, capital redemption reserve is a capital nature reserve. If nothing is mentioned, you will always presume that entire amount has been realized in cash. Is it clear to you? Now, first of all, how to compute the bonus share. Your total number of shares is 50,000. Bonus ratio is 3:5. Indirectly, it means if you are having 5 shares, company will give you 3 bonus share. Is it clear to you? So total 50,000 shares are there. So how many bonus shares will be issued? 30,000. The face value of the share is 100. So total bonus amount will be equal to 30 lakh. Is it clear to you or not? Bonus amount will be equal to 30 lakh. Now you are going to pass. Then you need 30 lakh. So first of all, you are going to look into your capital nature reserves. As I told you, security premium balance is a capital nature reserve, but out of 10 lakh, you cannot utilize 3 lakh, you can utilize only 7 lakh. Then capital redemption reserve can be utilized fully, but capital reserve, 5 lakh was the balance, you cannot utilize 3 lakh, you can utilize only 2 lakh. That means total 17 plus 2, 19 lakh you have utilized. 10 lakh now you can utilize revenue reserves, and 1 lakh from profit and loss account. So utilization of reserves is 30 lakh. So your entry will be all the reserves account debit to share capital. You can write in bracket bonus issue. Is it clear to you or not? This is how you are supposed to move in this particular question. Again, pay attention. Bonus to partly paid up share. Now suppose here it is written 50,000 equity shares of 100 each, 80 paid up, 40 lakh. Further, it is given general reserve, profit and loss account, dividend, equalization. All these are revenue nature reserves. Security premium obviously is a capital nature reserve. It is given on this date, director decided to make the shares fully paid without making the shareholder to pay for the same. Now, in this case, 50,000 shares of 100 but 80 paid. That means you have so far paid only 80. But now company is presuming that you have paid the entire amount. That means your share has been made fully paid. So again, it is a sort of bonus issue. But this bonus issue is to partly paid up share, to make them fully paid. So in this case, what will be the bonus amount? Because 50,000 shares are there and they are 80 paid up, 20 is yet to be called up. So 50,000 into 20, so total 10 lakh. So utilization of reserve, I told you, as far as bonus to partly paid up shares is concerned, only revenue nature reserves can be utilized. So general reserve 7 lakh, profit or loss account, dividend equalization fund, you will utilize the general reserve. And if you want to pass the entry, this time first you pass the normal entry, share call account debit to share capital, that is due entry for call. And now you write the reserves account debit to share capital, share call account in fact. If you have passed this entry, it is better to write to share call account. Is it clear to you? These are the points which we need to take care of as far as bonus issue is concerned. Is it clear? Simultaneously, there is another chapter that is rights issue. Coming over to the rights issue. And you are definitely going to get a question out of rights issue. I told you in my regular classes, first of all, you need to understand from the MCQ point of view that section 62 deals with rights issue. This is the only question which you need to take care of. Another important point. Now, in rights question, actually, what you are supposed to do. Now, just to make the point clear, let us say market price of the share is 46. First of all, you are going to note it down very carefully. What is the market price of share? Correct? Under the second step, you are supposed to compute average price, also known as X-right price, also known as theoretical price. Theoretical price, X-right price or average price is same. But how to compute the same? First of all, in this particular question, it was given that company has given rights issue in the ratio of 1 is to 10. Let us say. That means if you are having 10 shares, company is giving you 1 share. Company is giving you a right to purchase 1 share. 1 is to 10. 2 is to 3 means if suppose you have 3 shares, company is giving you a right to buy what we call 2 shares. So in this case, let us say 1 is to 10 is the rights ratio. First of all, you presume that you are having 10 shares. So in order to compute the average price, X right price or market price, you always presume first of all this way, because this is given, let us say in the question that rights issue is in the ratio of 1 is to 10. So first you consider 10, multiply it with the what we call price, market price. So total value, total market price of the share of 10 share is equal to 460, correct? Now, suppose if you are going to buy 1 share, because you have the 10 share and rights ratio is 1 is to 10. So you have a right to buy 1 share. And we further presume that company is giving you a right share at a price of 31, let us say. Now you will buy 1 more share. I will write here plus amount for right share. 1 into 31, that will be equal to 31. That means total price paid by me to acquire 11 share will be 491. Are you getting my point or not? Because market price of the share is 46. Correct? So for 10 share into 46, that comes to 460. And if I am going to buy 1 more share for 31, so total price will become 491. So if I am going to divide total 491 by total number of share, now 11. So that will give me average price. Is it clear to you? All I have to do is, because this will always be given in the question, market price, I have to compute the average price. Now I will have to compare this. So difference will be known as what we call value of right. Is it clear to you? I can pass the entry also. Now bank account debit. Now in this particular question, total rights issue is equal to 10,000. So 10,000 into 31, 3 lakh, 10,000 to equity share, 10,000 into 10, 1 lakh, and 2 security premium, because right share are being issued at the rate of 31 and face value of share is 10. So 21 will be the what we call face value. Is it clear to you or not? So this is how you are supposed to compute what we call rights share value. Let us say, just to make the point further clear, let us say rights ratio is 2 is to 5. Let us say it is given in the question. So always consider this is the base. Always note down what we call market value per share, which will always be given in the question. Let me tell you, in my regular classes, I also told you sometime market value per share is also known as come right market price. Sometime it is also known as come right market price. Come right market price or market value per share is one and same thing. Now all I need to do is to compute the average price. In order to compute the average price, I will look into the rights ratio. I will consider the right hand figure as the base. I will presume I am having the 5 shares. So market value of 5 share, 5 into market price 45 to 25. Now because this time ratio is 2 is to 5, that means I will buy 2 more share. And let us say rights price per share is 12. So 2 into 12, that will give me 24. So total amount will become 249. But total number of share will be 5 plus 2, 7. So this will be what we call average price. And the difference will be what we call value of right. Is it clear to you or not? Now in this question, it was also asked, what is the percentage increase in share capital? Actually, it was given in the question that your existing share capital is rupees 40 lakh. And because rights ratio is 2 is to 5, that means your equity share capital will increase by, you can simply write 40 lakh into 2 by 5. Your equity share capital will increase by 16 lakh. You simply divide 16 lakh by your original capital and multiply it with 100 to get the percentage increase in share capital. This is all you need to do as far as what we call your rights issue is concerned. Is it clear to you or not? Is it clear? So just wait for 5 minutes. We'll continue with this and I will just allow me 5 minutes. Correct? Hello and great welcome. So now as far as this quick fire revision series is concerned, we are picking up what we call underwriting. Correct? Now I told you when I start off in my regular classes that company, basically underwriting is a contract between the company and the persons And the persons, when I say it can be persons, they can be institutions also. And the guarantee is that these persons or institution will undertake the guarantee to get the shares of the debentures subscribed on behalf of the company. Underwriter, as I said, could be an individual, could be firm, could be a company. Obviously, because they are taking up such a big risk to get the shares subscribed, they are going to be paid for their services some consideration, and this consideration is known as underwriting commission. The company will have to deliver this consideration to the underwriters, so it is an expense from the perspective of the company. Now, importantly, from the MCQ point of view, as per Companies Act, such commission should not exceed 5% of issue price of the shares, and 2.5% in case of debentures, as far as issue price is concerned. In case of shares, 5%, in case of debentures, what we call 2.5%. Is it clear to you or not? Now, as far as types of underwriting is concerned, complete, partial, and joint underwriting. However, firm underwriting is the most important facet, and at the same time, you need to pay a bit of attention towards what we call joint underwriting. So, coming over to the joint underwriting, just pay attention here. This is joint underwriting. What we mean by joint underwriting, when more than one underwriter undertakes the issue. For example, total shares issued are 50 lakh. And let us say total applications received is equal to 48 lakh 50,000. And out of 48 lakh 50,000, marked applications are equal to 45 lakh 50,000. Marked applications means such applications which are bearing the mark or stamp of the underwriters. So, if I'm going to subtract from 48 lakh 50,000 marked application 45 lakh 50, I'm going to get what we call unmarked application. These are also known as direct application. I also told you that as far as unmarked applications are concerned, their credit is given always in gross liability ratio. For example, in this particular case, let us say gross liability, let us say Mr. A has agreed to subscribe 15 lakh, B 25 lakh, and C has agreed to subscribe for 10 lakh share. So this is your gross liability ratio, 15 is to 25 is to 10. Is it clear to you? Now, marked application will always be subtracted in absolute terms. In absolute terms, what does it mean? For example, it will always be given in the question that you have received 12 lakh worth of marked application from A, 25 lakh from B, and 8 lakh 50 from C. So you simply subtract the marked application. Now, coming over to the unmarked application 3 lakh, as I told you, it will be subtracted in what we call gross liability ratio. So you will divide the 3 lakh in the gross liability ratio of 15 is to 25 is to 10, and now you are going to get the balance amount. As you can see, the balance amount of Mr. B is negative. It means there is a surplus in B. Now, this surplus must be divided between A and C. And this surplus will be divided between A and C in between them in the gross liability ratio. Now, gross liability ratio of A and C is 15 is to 10. So, this 1,50,000 will be given credited to A and B. This 1,50,000 you will write here plus. We are writing it plus because we want to actually erase it out. Here it is negative, so I will have to write plus 1,50,000, it will become 0. And this 150 will be divided in the ratio of 15 is to 10, so 90 and 60. So finally the net liability will be 120 and 30,000. This is the point which you need to take care of. Is it clear to you or not? So one is your what we call questions related to, as I told you, gross liability, correct? Now the firm underwriting. Firm underwriting is the most important part of this particular chapter. Now, as far as firm underwriting is concerned, just pay attention. So we will pick up one question to make you understand better, so that just allow me a second. Just 1 second. So that there is no confusion at all. Correct? Now, this is firm underwriting question. Now, as far as this firm underwriting question is concerned, here it is written that Mosam Limited's authorized share capital is equal to 25 lakh. How much? That is equal to 25 lakh. Rupees 25 lakh. And it is divided into 1 lakh shares of 25 each. So, 1 lakh into 25 will be equal to 25 lakh. Further, it is given that company issued 25,000 shares of 25 each at a premium of rupees 10 per share. The entire issue was underwritten by XYZ. Importantly, company has issued only 25,000 shares. Further, this issue has been underwritten by X, Y, and Z. So 25,000 shares are there. 25,000 shares, as I told you, 15,000 are written by X, 7,500 by Y, Z 2,500, that comes to 25,000. But besides that, there is firm underwriting of 2,500, 1,000 and 500. I told you firm underwriting means these shareholders are willing to buy 2,500 share, 1,000 and 500 share at any cost. Sure underwriting. Certain underwriting is also known as firm underwriting. Is it clear to you? So they have given indirectly a guarantee that we are going to actually buy 2,500 share, 1,500 share, 500 share at any cost. Finally, it is also given that out of total issue 22,500 share, including underwriting, were subscribed. Including firm underwriting. That means out of total issue was 25,000. Out of total issue, 22,500 shares were subscribed. That means total application which we have received is equal to 22,500. Is it clear? It is given in the question. But total application includes applications for firm underwritten share also. This is what we mean by that, including firm underwriting shares. I also told you, even though these underwriters are going for what we call some shares, but they will have to apply it like a general public. So indirectly, in simple words, you try to understand it in this manner, that total issue was, out of total issue 22,500 share applications we received, and out of, and including, in those applications, there were applications including the for firm underwritten share. Also, it is given marked applications were 8,000, 5,000, 2,500. This is the question. Commission payable to underwriter is 5%. Below it is given benefit of firm underwritten is to be given to individual underwriters. What does it mean? Now, in order to make you understand it comprehensively, just pay attention. As I told you, total issue is equal to 25,000. Is it clear to you? Now, total applications which we have received is equal to 22,500, but it includes firm underwritten shares. Now, out of 22,500, 18,500 are marked application. Now, if I subtract from 22,500 total of marked application 18,500, I will be left off with 7,000. Of course, these 7,000 applications will be considered as unmarked application, but these unmarked applications are inclusive of firm underwritten shares. Because it was given that whatever application which we have received are inclusive of firm underwritten shares. Isn't it or not? So that is why, after having subtracted marked applications, whatever applications which we are going to have, we will consider that these applications are unmarked, but they are inclusive of firm underwritten shares. So that is why it becomes paramount of paramount importance that we need to segregate it into normal unmarked application and firm underwritten share. Because total of firm underwritten share is equal to 4,000. If we are going to total it up, see here, if we are going to total it up over here, that is 3.1. 2,500, 1,500 is equal to 4,000. That means total firm underwritten share is equal to 4,000. Is it clear to you? So now I may say that out of what we call 7,000 unmarked application, normal unmarked application is 3,000. Normal unmarked application is always subtracted or indirectly credited in gross liability ratio. Regarding firm underwritten shares, they can be, try to understand, they can be given credited in gross liability ratio or in absolute terms. Correct? In absolute terms means as it is. In gross liability ratio, you know. Now the point is that how will you decide that you have to actually give it credit in gross liability ratio or absolute terms? Because in the bracket I have written here, individual benefit of firm underwritten share is to be given. This time it is given in the question that individual benefit is to be given. So because it is given in the question that individual benefit is given, you must actually subtract the firm underwritten share as it is, that mean in absolute terms. Is it clear to you? Now, this is the only point. So first of all, you write the gross liability 15,000, 7,500, 2,500. You subtract what we call marked application. Marked applications are always subtracted in absolute terms. Unmarked applications were 4,000, that will be subtracted in gross liability ratio of 15 is to 75. Sorry, 150 is to 75 is to 25, that is 1,800, 900, 300. And firm underwritten share, in this case, absolute terms, 2,500, 1,500. Why absolute terms? Because it was given in the question that firm individual benefit is to be given. Is it clear to you? Now, whatever balance is there, because it is having a negative balance, this negative balance will be shifted to other ones in the gross liability ratio, and finally we will get the net liability 2,167,333. But under firm underwritten shares, you must, after having computed net liability, must add firm underwritten share in absolute terms. Correct? In the last step, when you are going to add the firm underwritten share, it must be added in gross liability ratio of 2,000 to 2,500 in absolute terms, sorry, 2,500, 1,500. Is it clear to you? So that is how you are going to figure it out. Just to make the point a little bit more clear. Let us say, this is question number, okay. Jupiter Limited issued 10,000 shares of 10 each, correct? The entire issue was underwritten by X, Y, and Z as follows. Now, entire issue of 10,000, so 5,000, 3,000, 2,000 makes it 10,000. And besides that, they have agreed for firm underwritten share of 1,500, 500, that makes it 2,000. Is it clear? Further, it is given shares applied for 9,000. Company has issued 10,000 shares, but we have received application of 9,000 shares. The marked application including firm underwriting shares were 3,500, 1,400, 1,600. This is most important point. This time it is given that whatever marked applications which we have received, total marked applications received this much. But these marked application include firm underwritten shares. So first of all, in order to compute the marked application, you subtract the what we call firm underwritten shares. 3,500 minus 1,000. So marked application will be considered as 2,500. 1,400 minus 500, it will be considered 900. 1,600 minus 500, it will be considered what we call 1,100. So you can say marked application is equal to 4,500. So marked application is 4,500. Is it clear to you or not? And we know that firm underwritten shares are 2,000. So I will write here 2,000. So if from 9,000 I am going to subtract marked application and firm underwritten share, I will be left up with pure unmarked application to the extent of pure unmarked application to the extent of 2,500. Isn't it? So all I have to do is first of all write gross liability, subtract what we call marked application in absolute terms. Then I will have to subtract what we call unmarked application. I will show you how I have done here. See here, gross liability 5,000, 3,000, 2,000 marked applications we have subtracted. Then unmarked normal applications are always subtracted in gross liability ratio 5:3:2. And firm underwritten share, this time nothing is mentioned in the question. Because this time nothing is mentioned in the question, so that is why I have used gross liability ratio. If nothing is mentioned with respect to firm underwritten share, whether individual benefit is given or not, in that case it is better to subtract it in gross liability ratio. Is it clear to you? So finally you will get the what we call 250, 750 and dash. So this will become your net liability, and then you add, because there is no negative balance, then you add your firm underwritten share in absolute terms, you get your total liability also. This is how what we call questions are done with respect to joint underwriting and firm underwriting, but firm underwriting is of paramount importance and you can expect a question out of this particular chapter. Is it clear to you or not? Today we are going to actually talk about banking companies, and quickly we will try to actually recap all the concepts associated with this long and lengthy chapters. In my regular classes, I talked a lot about what we call rebate on bills discount account. This happens to be the most prominent topic of this particular chapter, wherefrom you can expect a question surely in the examination. And in order to understand this one, let's presume that there is a balance given as opening balance of rebate on bills discount account 9 crores, correct? And this is our current year starting from 1/4/2026 and ending on 31st of 3/2027. This is our current year. We further presume that in the current year, total bills discounted from our bank is equal to 4,000 crore rupees, 4,000 crore. This is the amount of bills which are discounted from our bank. Obviously, if people are going to actually get their bills discounted from our bank, indirectly it means they are encashing their bills much before the maturity days. Is it clear to you? So obviously we are going to charge something, and that charge from the perspective of the bank is known as discount on bills discounted, or simply discount on bills. Importantly, it is an income for the bank. Is it clear to you? Now, further I have written here average discounted period 73 days. Indirectly, what does it mean? That means whatever bills which are being discounted, after 73 days, their maturity days will fall. Is it clear to you? This is what we mean by average discounted period. So on an average, we are discounting the bills 73 days prior to their maturity days. But however, further it is given that we are charging at the rate of 18% per annum. So obviously we are going to charge something, because if you are going to get your bills discounted from me, that means you are getting the cash today, but I'm the bank and I will receive the cash later on. That means 73 days later. So for 73 days, I am going to charge something from you. But out of these 4,000 bills, we presume that there are 600 crores worth of bills are there, whose 36.5 days are falling in the next year. 600 crores of bills are there. Obviously, they have been actually discounted 73 days prior to their maturity days. But out of 73 days, 36.5 days, let us presume, are falling in the next year. Is it clear to you? So first of all, what you are supposed to do? First of all, you need to note down your total bills discounted, which happens to be 4,000, number one. Number two, now you compute your income. What is your income? The discount which you are going to earn. So discount which you are going to earn will be computed in this manner. Total bills discounted 4,000, discount charges are 18%, and you are getting the bills discounted 73 days prior to the maturity days. So 7 into 73 divided by 365. So total discount income is 144. This is the point which you need to take care of. This is your total discount income. 144 crore is your total discount income. This is your discount income, no doubt about that. But how much of this portion you are going to recognize in the current year's P&L? So for that, what you are supposed to do, first of all, you are going to subtract closing balance of rebate on bills discount account. Now, what we mean by closing balance on bills discount account? It is also known as unexpired discount account. So closing balance on rebate on bills discount account indirectly means such bills which are maturing in the next year. So you are going to actually compute the proportionate discount on such bills on such days which are falling in the next year. For example, as I told you, out of 4,000 crore worth of bills, 600 crores of bills are falling in the next year. So you are going to write here 600 into 18 by 100, but number of days which are maturing in the next year will be equal to 36.5. So 36.5 divided by 365, it comes to 10.80. Indirectly, when we say rebate on bills discount account, indirectly it means we are referring to that part of income discount on bills which we are not recognizing in the current year. So this is known as closing balance of rebate on bills discount account. Is it clear to you? That means this is that part of the income. Our total income is 144 crore, as I told you. But out of 144 crore, I am not going to recognize 10.80 worth of income. Why? Because it relates to such bills whose maturity days are falling in the next year. Is it clear to you or not? Similarly, if in the question we will be given opening balance of rebate on bills discount account, for example, let us say opening balance of rebate on bills discount account happens to be 9 crore. So all I have to do is to simply add it. But logically, you need to understand, what does opening balance means? It means it refers to income of the last year which was not recognized last year, but it will be recognized in the current year. For example, 10.80 worth of income we did not recognize in the current year, but obviously we are going to recognize it in the next year. So by adding opening balance of rebate on bills discount account and subtracting closing balance, you are going to get the amount which you are going to recognize in the P&L account. Is it clear to you or not? Mostly the question which you will be asked from this particular topic, to be very honest with you, will be related to actually what portion of the income of discount on bills which you are supposed to actually recognize in the profit or loss account. In case if entries are passed, you can pass the entry. I told you several times in my regular classes, first of all, you are going to close the opening balance of rebate on bills discount account. Now, rebate on bills discount account, it is having a credit balance. Now, you are going to actually close it. So, you are going to debit it. You are going to credit discount on bills account, because when this income was not recognized last year, now you are recognizing it in the current year. So your current year's income discount on bills will increase. So that is why you are supposed to pass this particular entry. Then you are going to pass second entry for the income which you have earned in the current year. Actually, in the current year, you got 4,000 crore worth of bills discounted, and total income earned by you is equal to 144 crore. So your entry will be bills account debit to discount on bills account, and then you are going to pass the next entry, discount on bills account debit to rebate on bills discount account. Is it clear to you? On the basis of this, now you can prepare these account, and finally when you are going to balance this, it will tell you how much of income you are going to actually recognize in the profit and loss account. Is it clear to you or not? For example, another question, let us say rebate on bills discount account is equal to 20,000 and my current year is 22-23, and total bills discounted is equal to 35 lakh. And income which we have earned on these bills in the current year, that is discount on bills, is equal to 5 lakh. Opening balance 20,000, rebate on bills discount account. Closing balance is given to you. So quickly, within a flick of second, you should be in a position to compute what we call how much income you are going to recognize. Because your total discount which you have earned in the current year is 5 lakh, opening balance of rebate is given, you add it, and closing balance rebate is given to you, just subtract it, you will come to know actually that this much of income you are going to recognize, 4 lakh 90,000. Or you can pass the entries, and accordingly actually you can do, for example, opening balance of rebate on bills discount account debit to discount on bills account. This will be the first entry. The total discount which you have earned, bills account debit to discount on bills account. And for closing balance, you are going to write discount on bills account debit to rebate on bills discount account. Then after preparing the ledger account, you will get 4 lakh 90, which, or you can directly in your rough, you can find out this particular figure by adding opening balance and subtracting closing balance to the discount on bills. Is it clear to you or not? Now, if you remember, sometime actually you will be given in the question actually you will be given some bills and whose maturity date will fall in the next year. For example, opening balance of rebate on bills discount account is given to me, let us say 28,000. It is also given, let us say 1,02,000 worth of discount we have received. This is my income which I have earned. Obviously, I will add opening balance to it. Now I am supposed to subtract the closing balance of rebate on bills discount account. But this time, let us say, or in some questions, you will not be given the closing balance of rebate on bills discount account. So what you are supposed to do? Under such questions, you will be given some bills and their maturity date will be given to you. Let us say we are given 3 bills, 65,000, 1 lakh 54 lakh 30, and you can see their due date is after this date. This is the end of current year, 31st/3/2026, but due date of this bill is 14/6/2026, then this one. That means all these bills are falling in the next year. So what you are supposed to do, you are going to compute the number of days. So you will compute the number of days. When we say we are supposed to compute the number of days, that means from the end of the current year till the due date, we are supposed to compute the number of days. You will compute 75, 110, 132. In my regular classes, I also gave you a clue how to compute the number of days quickly. Is it clear to you? Now, you compute the proportionate discount. For example, 65,000 rate of discount on this bill is 13%, and number of days 75 by 365, 1736. Next bill, 150, 1 lakh 50, and number of days is 110. So 1 lakh 50. Now this bill's discount rate is 15% into 110 divided by 365 and so on. Now by totaling up all these items, you will get what we call total discount of these bills, and these bills are falling in the next year. So this discount will be considered as what we call rebate on bills discount account closing balance. Is it clear to you or not? So that means what amount you are going to transfer to P&L. Your total discount earned is given in the question 1 lakh 2, opening balance is given, you are going to add, now you are going to subtract the closing balance, and this is how you are going to find out the amount which you are going to credit to your profit and loss account. This is the first major topic, correct? I would like you to do at least question number 3.3 from this particular 1.3 from this particular question topic. Is it clear to you? Now we come over to the second topic. Second topic relates to classification of asset into performing asset and non-performing asset. I told you when we say assets from the perspective of the bank, indirectly we are referring to loans and advances, because these are the major assets. These are the major assets for a particular bank. Now all the loans and advances are classified into performing asset and non-performing asset. Why? For the purpose of recognition of interest income. Should we recognize the interest income or not? For this purpose, we have to categorize our loans and advances into performing and non-performing asset. I told you actually in my regular classes, when we say it is a performing asset, indirectly it means we are sure that no default will be created. And when we say it is non-performing asset, indirectly it means we have a hunch that default may be created. So if we are sure that it is a performing asset, then whatever interest is there, for example, in the current year, total interest due is equal to 1 lakh. Let us say I am a bank and I have given a loan to a customer, and total interest I was supposed to receive 1 lakh. This 1 lakh is known as interest earned. But interest earned doesn't mean this income has been received. I told you 1 lakh is the total interest. And let us say out of 1 lakh, 70,000 has been received, but 30,000 hasn't been received. This is the point which you need to understand. Let us say out of 1 lakh, total interest, it is known as interest earned. Many people confuse interest earned with interest received. No, interest earned means you have a legal right to get 1 lakh. But how much you received? We presume, let us say I received only 80,000 and 20,000 is still due. Now, if this asset, if this loan and advances is a performing asset, if it is a performing asset, whatever interest I have received and whatever interest due I am going to recognize. That means entire 1 lakh will be recognized, irrespective of the fact whether I have received or not. Is it clear to you? However, if it is a non-performing asset, in that case, only the portion which I have received will be recognized in the current year. Is it clear to you? Very simple questions are there from this particular topic. I need not require to talk much, so I simply recapitulated it. Is it clear to you or not? Another important topic from this particular area is provisioning of asset. From this particular topic also you can expect question in the examination. Provisioning of asset. I told you the basic purpose of the bank is to give loans, and they are the major assets for a particular bank. So all loans and advances of the banks are basically categorized into standard assets, substandard assets, doubtful assets, and loss assets. Importantly, you need to know what are the rates of the provision. Obviously speaking, suppose if in the question you are being given only standard asset. Indirectly, standard asset means actually we expect that there won't be any default in it. As a clear to you, we are sure that entire amount which we have given will be received. Such loans and advances are known as actually standard assets. If in the question it is simply given standard loans, you are going to apply what we call 0.40%. You are going to make a provision at the rate of 0.40%. Is it clear to you? 99.9% you will always be given in the question standard assets only. And if it is an standard asset, you are going to actually apply this particular rate. However, just to confuse you, they may write actually, for example, in this manner, standard asset, and let us say in bracket they write like this, for agriculture or small and medium enterprises. They have written standard asset. Now suppose if they write in bracket that it is meant for agriculture or for small and medium enterprises, in that case, for objective type question, you should be what we call careful about this. In that case, even though it is a standard asset, but if it is meant for what we call agriculture and small and medium enterprises, your rate will be 0.25%. Similarly, if it is given it is an standard asset and this is for CRE, commercial and real estate sector, in that case 1% provision will be made. But if simply standard asset is given, the provision will be made only at the rate of 0.40%. Is it clear to you or not? Substandard asset. Substandard asset. If in the question you are given substandard asset, is it clear to you? Indirectly, in simple word, in common layman's language, substandard assets means although there is some possibility that amount of loan may not be recovered, but there is greater probability that the entire amount will be received. Now, if in the question you are given substandard asset, Substandard asset, if it is given secured, in that case you are going to apply what we call percentage at the rate of 15%. If it is given that this substandard asset is unsecured, if it is given unsecured, then you are going to apply a percentage of 25%. Generally, in case of substandard asset, you will be given in the question secured or unsecured only. However, just to confuse you, sometime they may give that out of these substandard assets, let us say some assets are for infrastructure purpose, in respect of infrastructure purpose where escrow account exists. Now, if it is given that standard asset in respect of infrastructure purpose where escrow account exists, in that case, the percentage will be 20%. Is it clear to you? Regarding substandard asset, you need to be careful about all these three percentages. Is it clear? Coming over to the doubtful assets. Doubtful assets means, in simple words actually, in a common layman's language, although I have written here concrete definition, but in a common layman's language, doubtful asset means there is greater probability that we are not going to recover the amount. Is it clear to you? But in banking language, we call it refers to such loans and advances that have remained NPA for a period exceeding 12 months. But anyway, if in the question you are being given doubtful loans and advances, first of all, before you start making the provisions, first of all, you check whether these doubtful debts are secured or not. If they are not secured, that means unsecured, then no problem. That means such doubtful debts which are unsecured, you are going to make a provision at the rate of 100%. But if they are secured, you are going to make a provision at the rate of 25% if time period is from 0 to 1 year. If time period is more than 1 year and up to 3 years, then you are going to make a provision at the rate of 40%. If it is more than 3 years, then you are going to create a provision at the rate of 100%. And you should be absolutely thorough with the rates with respect to doubtful debts. Regarding standard, I told you, generally we are going to create a provision at the rate of 0.40%. However, just to confuse you, if in the examination it is given a standard asset, but in bracket they write for agriculture or small and medium enterprises, you are going to actually create a provision at the rate of 0.25%. But similarly, if they write what we call a standard asset for CRE purpose, commercial and real estate sector, in that case 1%. Substandard asset secured 15%. I told you unsecured 25%. For infrastructural projects where escrow account exists, you are going to create provision at the rate of 20%. But regarding doubtful loans and advances, you have to be extra cautious. If they are secured, then you will take the length of the time. Is it clear to you? 0 to 1 year, 25%. More than 1 year, but up to 3 years, 40%, and above 3 years, 100%. If they are unsecured, obviously you are going to give 100% provision. Is it clear to you? This topic is also simple. You can easily do the questions we wanted to revise. Another important topic is ECGC coverage and DCGC coverage. In order to understand this, just pay attention this. Over here, suppose there is a bank. Is it clear to you? There is a bank, and it gives a loan to a customer or an industrialist or a small and medium enterprise, let us say worth rupees 70 lakh. And let us say this loan was given 4-5 years back. And now we are in the current year. When I say we are in the current year, let us say on 31st/3/2007, already 4-5 years have gone by. But there is a default in interest. Is it clear to you? And this loan has been given through government guarantees, respective department, let us say Depository Insurance Credit Guarantee Corporation or Export Credit Guarantee Corporation. As I talked in my regular classes at great length, actually, I have talked about actually how these departments function and how the loans are taken, procured. But in simple words, you can see in the question you will be given, for example, in this question, it will be given to you this way, in this manner, just to make the point clear. Axis Bank Limited has given some loans, and the balance out, and this loan was given on 31st/3/2021, but the current year is 31st/3/2025. So you can see 4 years have already gone by. Amount of loan is 70 lakh. Now in the question it is given DICGC. So whenever in the question DICGC or ACGC is given, you immediately should strike to you that this question relates to this particular topic. Further, it is given that securities held is equal to 30 lakhs, and realizable value of the security is equal to 20 lakh. So in order to solve such question, the first thing which you need to understand is that actually on 31st 3 2000 we were talking about, just wait. The first thing which you need to understand regarding such point is that this entire loan of 70 lakh which this bank has given will be considered as doubtful. It will be considered as doubtful. This is the first thing which you need to understand. Is it clear to you? This will be considered as doubtful. Is it clear to you or not? Clear? Why it is considered as doubtful? Because generally, if we are not going to receive interest for 90 days, generally such loan is considered as doubtful or NPA. Is it clear to you? Now, in this case, already 4 years have gone by. So this entire loan will be considered as doubtful. The first thing which you need to understand is this. Why I am stressing upon this? Now, if this loan is doubtful, just a moment ago I told you what are the provisions of the doubtful. If there are doubtful debts, if it is a secured, such loans and advances which are doubtful, what are the rules? For secured, 0 to 1 year, as I told you, and as per the length of the time we are going to what we call apply the percentages, 25%, 40%, then 100%, above 3 years, that is equal to 100%. Is it clear to you? However, if it is unsecured, then we apply 100%. Is it clear to you? Importantly, this entire loan of 70 lakh will be considered as doubtful. Is it clear to you or not? This entire 70 lakh. Now, the main point is that you have to segregate it into 3 parts. How you are going to do that? First of all, because you are the bank and you have given 70 lakhs worth of loan, you are not going to give without any security. You have taken some security worth rupees 30 lakhs, but their realizable value is 20 lakhs. So first of all, you are going to write here A, realizable value of security 20 lakh. It means this is the portion of doubtful debts which is secured. This is because you have a security whose realizable value is 20 lakh. Is it clear to you? So, out of 70 lakh, I can say realizable value is rupees 20 lakh, and this is portion of doubtful debts which is secured. Now, from 70 lakh, because total loan is equal to 70, now I am going to subtract 20 lakh. Is it clear to you? Because I know that out of 70 lakh, 20 lakh is secured. Remaining is 50 lakh. On the remaining part, you apply the percentage. In this question, it is given DICGC percentage is 50%. 50% of 50 lakh will be equal to 25 lakh. So this is 25 lakh. That means out of this loan of 70 lakh, 25 lakh is also covered by DIGC guarantee or government guarantee. Is it clear? So out of 70 lakh, 20 lakh is covered by realizable value, and you just computed 25 lakh also covered by government guarantee. The remaining portion will be considered as unsecured. So after segregating the entire loan amount into realizable value of security, into covered by government guarantee and what we call unsecured, now we have to make the provision. And when we are going to make the provision, we have to be absolutely clear about the what we call rules. Now, provision, you can say A, portion covered by realizable value of security. I told you this entire loan is doubtful debts, number 1. Number 2, this is secured portion. And just a moment ago, I told you if it is a secured portion, correct, doubtful debts, which is secured, as per the time period, we have to provide the provision. Now, in this case, time period is more than 3 years. So that is why I am going to provide provision at the rate of 100%. So 20 will be the provision. Regarding 25 lakh, which is covered by government guarantee, no provision is needed. You need not require to create any provision on the portion which is covered by the government guarantee. However, portion unsecured, I told you Doubtful debts which are unsecured, provision is created at the rate of 100%. So you are going to create provision at the rate of 100% and you are going to get what we call this answer. So at least 2 questions you must do. Is it clear to you out of this particular topic? And this is how you have to move as far as this topic is concerned. Now, regarding that, honestly speaking, the first 4 topics are very important from the examination point of view. You are not supposed to receive any question, but just to recap the things. Sometime question, actually under this topic, there is a topic with respect to preparation of profit and loss account also. As you know, a banking company is going to prepare what we call as per Form B and as per 3rd schedule of Banking Regulation Act 1949. Is it clear to you from the examination point of view, especially MCQ question may be asked. As far as P&L account of a banking company is concerned, it is prepared in a vertical format as per the format given in Form B of 3rd schedule of Banking Regulation Act of 1949. Is it clear? As we know, profit and loss account is prepared in what we call 4 segments: income, expenditure, profit and loss account, and appropriation. In order to prepare this account, first of all, we write actually in the first part income. We write below it. First of all, you write particular schedule number and amount. And then you write interest, schedule number 13. Then you write other income 14. You total it up. Is it clear to you? So, this is your total income. That means generally, as far as your income part is concerned, 2 segments are there, interest and other income. As far as your expenditure part is concerned, here you are going to write interest expended. Interest expended schedule number 15. Similarly, operating expenses. After that, there is another part known as provisions. So, provisions and contingencies generally we write, but there is no schedule number for it. Is it clear to you? Now, we will add all this. It will give me total expenditure. Is it clear to you? So, total income and total expenditure you have got. Now, in the 3rd part, you will write profit and loss account. If there is some opening balance, you are going to write it. Otherwise, you take the difference of these 2, you write it over here also. Profit. First of all, you compute the net profit for the current year by subtracting what we call expenditure from the income. And if there is some opening balance, you write profit brought forward also. Total it up, it will tell you total profits. Then after that, you simply appropriate the amount and that will be considered as balance carried down. Correct? Just to make the point further clear. Just wait. Okay. Just to have a good idea regarding interest income, under schedule number 13, what income we are going to include? Any interest which the bank is supposed to receive on account of cash credit, on account of overdraft, and on account of loans. Importantly, under the interest income, we also include the discount on bills which we covered under topic number 1. But when you are going to write here discount on bills, don't forget to add opening balance or rebate on bills discount account, closing balance of rebate on bills discount account, correct? And then whatever income you get, you are going to write. Then similarly, interest on balances with RBI or other banks also. So that will tell you what we call total interest income, which you are going to put it over here. Is it clear? After that, you have to write here other income. As far as other incomes are concerned, you are going to write here commission, brokerage, exchange, profit on sale of security, profit on sale of security, profit on sale of land and building, motor vehicle, any dividend received, go down rent, locker rent, etc. So many incomes are there. Is it clear to you? Other incomes. So a bank receives other income generally through commission, brokerage, exchange, but besides that, there could be income from dividend, go down rent, locker rent, or profit on sale of investment, etc. So after adding it, you will get the what we call other income. So you are going to write the other income in your profit and loss account. So now you will get the total income. Is it clear to you? Similarly, now you are going to compute interest expended. Generally, it has only 2 components, interest on deposits. As we know, people what we call deposit their savings with the bank, and bank actually provide them interest. So it is an expenditure from the perspective of the bank. So interest on saving bank deposit, fixed deposit, etc. And also bank sometimes takes what we call borrowings, and bank has to pay interest on the same. So interest on borrowing. So total expenses you are going to write over here. that is interest expended. Is it clear? Similarly, operating expenses, very easy. Operating expenses, payment to employees, rent, taxes, lighting, advertisement, publicity charges, depreciation, director fee, allowances, auditor's fee, insurance, etc. So you will compute that also. So after having computed what we call interest expended in this much, now you may have to compute provisions and contingencies. Under provisions, we generally write provision for tax, provisions for loans and advances, or provision for decline in value of what we call current investments. Generally, these three items fall under it. So if it is given in the question provision for tax, provision for loans and advances, or provision for decline in value of current investment, you are going to write. So then you are going to add all these three items, you are going to get your total expenditure. So from the income, you are going to subtract the income, and then you are going to write net profit for the current year. If in the question it is given net profit brought forward, you also add it. So total profit will be equal to this much. Now, after this, we have to actually transfer to reserve account. Correct? If there is any question, if there is some information in the question that this much amount we need to transfer to general reserve or to proposed dividend, these are known as proposed dividend. So we are going to make a transfer. Is it clear to you? These are known as appropriation, and I'm going to subtract these appropriation from this amount, and I'm going to get what we call balance carried down. Just to make the point a little bit more clear. For example, let us say I'm doing a simple question just to make the point. Interest on loan is equal to this much, interest on overdraft, interest on cash credit, discount on bills. Total interest income is this much. Let us say as far as other income is concerned, only commission is given to us. So total amount is equal to 8,000. Is it clear to you? Expenditure. Let us say only one item is there, interest on deposit. And operating expenses, sundry charges, rent and taxes, payment to employees, auditor's fee, director fee, total is equal to 851. And then provision and contingency, generally here I write provision for doubtful debts or any provision which I am supposed to make. So 300. So total will be equal to this much. By subtracting total expenditure from the income, I will get net profit 3649. And there is no opening balance. So I will simply put up a dash. Importantly, in this particular question, there is no information regarding transfer to general reserve or proposed dividend. But you have to statutorily transfer some amount. That is 20% of balance carried down. So 729.80. So with that, you are going to get what we call this particular figure. Is it clear to you or not? Sometime in the question, the direction will be given, 25%, 20%. If no direction is given, my advice is to take 20%. Is it clear to you or not? So this is how all these questions have been actually done in the same format. But honestly speaking, I don't expect a question out of this particular topic. Is it clear to you or not? Now, section 6 is very important. Topic number 1, topic number 3, and topic number 6 are very vital. You can get a question out of this. Now, what this particular topic is? Actually, section 6, I told you, actually it deals with how to classify the loans and advances into secured and unsecured. How to classify. So, in order to classify loans and advances into secured and unsecured, what a bank does actually. See here. Let us say my current accounting year is starting on 1/4/2024 and ending on 31st of 3/2025. Is it clear to you? We also presume that our bank has given a loan to a customer and the loan amount is 50 lakh, and we gave this loan at the rate of 14%. That means our bank is supposed to charge 14% interest per annum. Obviously, it's a pretty heavy loan. So we are not going to actually give the loan free of cost to a customer. Obviously, we are going to have some security of him. Let us say we took security of him. He had made some investment. So we asked that fellow, okay, you can give your shares to us as security. So we took his shares as security. There are 1 lakh shares. On this date, actually we gave the loan 30th of 9/2024. We gave a loan of 50 lakh. And on this date, the value, market value per share was 98, and we took 1 lakh shares as security. That means 98 lakh worth of security we took, and we gave a loan of 50 lakh. No problem. When we reached the end of the year, what we found out actually, that particular fellow to whom actually we gave the loan on 30th of 9/2024, he hasn't paid the interest and he hasn't paid the principal also at the end of after the 6 months, because accounting year will end here, 31st/3/2025. So we came to know actually neither we have received any interest nor we have received any installment repayment. So first of all, I'm going to compute the amount of interest on 50 lakh at the rate of 14% for 6 months. That will be equal to 3,50,000. Now you try to understand this point. You have given a loan of 50 lakh. Is it clear to you? Loan amount is equal to 50 lakh. And 3,50,000 is interest. So total amount due, because he hasn't paid any installment. So now the total amount due is equal to 53,50,000. Now I have reached the end of the accounting year. Point is that now I have to categorize this loan as secured and unsecured. So how I will do that? Point is this. In order to categorize this loan as secured and unsecured, what I am going to do, just pay attention. In order to categorize the loan amount as fully secured or otherwise, the value of security on the last date of the year will be considered. On the last date, I am going to consider the value of the security. I find that market value of share is 85. So market value of security will be 1 lakh into 85, that is equal to 85. And 85 lakh covers quite well the entire amount of 53 lakh 50. So this loan amount will be considered as fully secured. Is it clear to you? Value of security as at 31st/3/2025 is 85 lakh. So thus this loan will be classified as fully secured as it covers the full amount of principal and interest due. Is it clear to you? Now suppose the value of security would have been only 50 lakh. Suppose. In that case, my answer would have been this way, that out of 53 lakh 50 lakh will be classified as fully secured, while the remaining one will be classified as unsecured. Is it clear to you or not? This is how we have to actually move about as far as this particular topic is concerned. Now, my only piece of advice is that you need to do this question, 2024 question, which I have done in the class. You must do this particular question because I have done this question at length and it is on same pattern. So at least this question you must do besides what we call, you can do either 6.3 or 6.3 or this question, whichever you may like to write. Correct? But at least do one question of this particular topic. So this in its entirety I have covered banking company. Is it clear to you? I hope it must have actually come up to your expectation. Looking forward to have your session. Shall meet you in the next session. Correct? In fact, I am going to meet you after 5 minutes only. Hello and great welcome. So now in this particular session, we are going to quickly revise what we call insurance companies. It happens to be again a pretty long chapter. So as far as insurance, I talked about in my regular classes that it happens to be a contract between the insurance company and the client or the other party. And the insurance company is also known as insurer, while the client or the other party is also known as insured. Now, as per the contract, the insurer, that means the insurance company, will agree to bear the risk and compensate the other party in case if the risk or the uncertainty materializes. Is it clear to you? As far as types of insurance are concerned, I talked about this particular fact that they can be broadly classified into two types, general and life insurance. Is it clear to you? General insurance basically means insurance other than the life insurance. And generally, the general insurance are broadly classified into three types, that is fire, marine and miscellaneous. Under the miscellaneous, we include motor vehicle insurance, burglary, workman compensation, exchange risk or credit risk, etc. But broadly they are classified, and all general insurance are broadly classified into fire, marine and miscellaneous expenses. Is it clear to you? Now, as far as accounting is concerned, we are supposed to prepare here a profit or loss account. In order to prepare the profit or loss account, the insurance company, first of all, write the name of the insurer, and then you write the registration number in that date of registration with IRDA. IRDA means Insurance Regulatory Development Authority, and this is revenue account for the what we call so-and-so period. Now, when we prepare the revenue account, first of all, we write details, then serial number and amount. And first of all, we write here premium. It has got a schedule. We write schedule number 1. And in case if we have some other income, interest, dividend and rent, we will take that, but no schedule is given. Any other income is also there. We will include here. But main income is premium earned. Is it clear to you? So total income will be there. And then we are going to write all the expenses. Major expenses are claims. It has got schedule number 2. Then commission. It has got schedule number 3. Then operating expenses, schedule number 3. We will total all the expenses. We will subtract all the expenses from the total income. We will get the operating profit. This is how we are supposed to actually move in this particular chapter. Now, in order to compute the premium receivable, most important part is premium, calculation of premium. In order to compute the premium, actually, I talked about this particular fact that an insurance company can receive premium directly, or it can receive the premium from other company. When we are going to receive the premium from other company indirectly, it is known as reinsurance. So whatever premium which we have received directly or indirectly, we are going to take that into account, and any outstanding at the end of the current year will be added, and any outstanding in the beginning of the year will be subtracted. Just for simplicity's sake, let us say from direct we have earned 100, and then from what we call indirect business we have earned 150. Then we are going to add opening, we are going to add what we call closing balance at the end of the year, and we are going to subtract opening balances, and then I'm going to add. It will tell me how much premium I was supposed to receive in the current year. I means the insurance company. Similarly, from the premium receivable, now I have to subtract the premium payable. Quite importantly, premium can never be paid what we call to the party. Correct? It can be payable to other company who have given some business to us, isn't it or not? So, sometime it happens actually. For example, suppose I have received a big business from a client. Obviously, from that particular client, I am going to receive some premium. And let us say I have transferred some business to other party. So, from my premium income, I will have to give some portion of the premium to that party to whom actually I have transferred the business. So, premium paid, whatever premium which we have paid, I am going to write. Of course, premium paid can be related to indirect business, that is reinsurance. And then current year will be added, last year will be subtracted. Then I will get what we call total premium payable. From the total premium receivable, I am going to subtract the total premium payable. That will give me net premium payable. Net premium receivable, sorry. Once we have computed the net premium receivable, then here, as I talked about this particular point in my regular classes, we have to actually do some adjustment known as adjustment for reserve for unexpired risk. Opening balance of reserve for unexpired risk will be added, and closing balance of reserve for unexpired risk will be subtracted, and then whatever figure which we are going to get, we are going to put it in the P&L, in the revenue account. Is it clear to you or not? Importantly, generally it will be given in the question at what rate you are supposed to create the what we call reserves. Opening balance of reserve will always be given, but closing balance of the reserve will have to be computed. Now, 50% fire insurance. If it is a case of marine, you are going to apply a percentage of 100%. If it is miscellaneous, then you are going to apply a percentage of 50%. Is it clear to you? Just to make the point more clear. For example, total premium receivable is 5 lakh. Total premium payable is equal to 2 lakh. That means and opening balance is 1 lakh. So first of all, I will compute premium receivable, which is 5 lakh. I will compute what we call premium payable. I will subtract it. I will get net premium receivable. Opening balance will be added. Opening balance of reserve for unexpired risk will be added. Now I have to do an adjustment. I will subtract less closing balance of reserve for unexpired risk. Reserve for unexpired risk closing balance will always be computed on net premium payable. Is it clear to you? Net premium payable is equal to 3 lakh. And because it is a fire insurance company, I will create a provision at the rate of 50%. So minus 150 and 2 lakh 50, I am going to reflect it what we call in my balance sheet. Is it clear to you or not? And similarly, all these questions are related to this. Now, similarly, we have to compute the calculation of the claims. As you know, actually, if the risk or the uncertainty materializes, the insurance company is bound to what we call pay some amount, because the other party is bound to claim the amount. Is it clear to you? It is an expense. Similarly, claim is generally payable on direct business, but it can be payable on what we call indirect business also, depending upon the what we call transfer of the business. Is it clear to you or not? Now, suppose we have paid on direct business, and suppose we have paid on indirect business, I will simply add. And as I told you earlier, the closing balances will be added, and opening outstanding balance will be subtracted. That will tell me what we call, then I will compute these two figures, I will add them, I will get what we call claims payable. And from the claims payable, I will subtract the claims recoverable or claims receivable. Are you getting my point or not? We can receive some claims also. It happens when we have transferred some business to the other party. Is it clear to you? Suppose from the other party we have received claims of this much, and then current year outstanding I will add. I am going to subtract the opening outstanding. Then it will tell me the total claims recoverable. From the total claims payable, I will subtract total claims recoverable. I will get the net claims, and you have to be cautious here. In case if there are some expenses in connection with the settlement of the claim, you should not forget to actually write here and then add it here and then get the what we call total amount of what we call claims. Is it clear to you or not? Is it clear? So this is how we are supposed to move about as far as this particular chapter is concerned. Now, generally in this particular section 2 is very important. In section 2, actually, you will be asked to prepare a revenue account. For example, let us say we are being given premium received. Correct? In the question directly it is given premium received. In the question it is not given current year's outstanding, last year's outstanding. So my premium receivable is equal to 1,200. It is also given in the question premium payable, paid on reinsurance ceded. Paid on reinsurance ceded, but the important point is that premium have been paid. So I will write here 90. No current year outstanding, no opening outstanding is given. So payable will be equal to 90. I will subtract 90 from 1,200 to get net premium receivable. And now opening reserve for unexpired risk is given in the question. I will add, but here in this particular question it was given to us that closing balance, the closing reserve for unexpired risk need to be created at a percentage of 40%. Now if some percentage is given in the question, obviously you will have to follow that. So that is why we have taken 40% of net claim 1,100, which happens to be 444. So finally I will get this much of amount which I need to reflect in the revenue account. As far as claims are concerned, in the question it was given that claims paid 440, then current year outstanding I will add, last year outstanding I will subtract, it will give me payable. Regarding recoverable, no information is given. So your net payable is equal to 470, and it was given that there are some expenses in settlement with the claim. You are going to add it, you will get 479. So now you can prepare the revenue account. Details, schedule number and amount. Your premium which you have computed 1146, there is no other income, so total income is equal to 1146. Now you subtract claims, commission is given in the question, expenses are given in the question, you get what we call total 879. The difference of 1146 and 879 will be your operating profit. Is it clear to you or not? Similarly, 2.2 is given. Similarly, 2.3. All these questions are more or less says just have a look over 2.3. In 2.3, let us say we are being given regarding premium information that we have received on direct business this much, on indirect business this much. There are no current year outstanding or last year outstanding is given, so I will add both these and I will get total premium receivable. Similarly, now I will subtract what we call premium payable. Total premium paid 475, no current year outstanding, no last year outstanding are given. So total premium payable is equal to 475. I will subtract 475 from 75,25,000 to get what we call 70,50,000. I'm going to add opening reserve for unexpired risk, which comes to 24,50,000. Now I'm going to apply, see here, closing reserve for unexpired risk. In this particular question also, direction was given that you have to create reserve for unexpired risk at the rate of 40%. So net premium 70,50,000, 40% you apply, you get this figure. And then finally 66,80,000, this figure will be presented in the revenue account. Regarding claims, you are given that on direct business you have paid this much, on indirect business you have paid this much. Current year outstanding and last year outstanding is given. So total claims payable on direct business, indirect business you have computed. Now you add it, you will get 48,16,000. That is your total claims payable. Now you subtract claims recoverable. In order to recover the claims, you will write 325, then add current year outstanding, last year outstanding, you will get this particular figure. And you will get the net claims, and in the question it is also given there are some expenses in connection with settlement of claim to the extent of 80,000. So 45,26,000 will be total amount of claims. Regarding commission, you were given that on direct business you have paid a commission of 1,50,000. Even on indirect business you have paid 1,11,000. So total commission paid is 1,61,000. But you have received some commission. So you subtract 14,000 from 1,61,000 to get what we call net commission expenses of 1,47,000. Regarding expenses, 2,30,000 were given, but it was also given in the question that out of 2,30,000, 80,000 related to claims. So you subtract 80,000 because you have already taken 80,000 in this calculation of claims. So you will be left off with 1,50,000. Is it clear to you? Now this will be your revenue account. When you are going to prepare the revenue account, All this figure will be presented here. Premium income, no other income is given. So total income is 66 lakh 80. Now claim amount, commission amount, expenses account, and finally you will get the operating profit. At least 2.4 you can do it by yourself. And in this question, there is a section 3 also, which is very quite important. In this particular section, actually what you are given, in this particular section, you are given there is a marine, there is a fire insurance, there a particular insurance company is having 3 insurance businesses: marine business, fire insurance business, and miscellaneous business. It is given in the question that premium which you have computed on marine is 50, on fire is 96, on miscellaneous is 36. Total premium collected. And total paid is equal to 20, 10 and 15. So net premium will be equal to 30 lakh, 86 lakh and 17,000. Now opening reserve for unexpired risk is also given in the question. You simply add opening reserve for unexpired risk, but closing reserve for unexpired risk you will have to create. I have already told you several times that it is created on net premium. Because it is a case of marine business, in case of marine 100% provision will be applied. So your closing reserve for unexpired risk will be equal to 30. Similarly, in case of this, because it is a case of fire, so you are going to apply 50%, even miscellaneous 50%. So now your total premium income 30, 83, 18.15 is concerned. But in this question hasn't asked you actually calculation of premium income. Question has asked you to prepare to pass entries for reserve for unexpired risk account. How to pass the entries? See here, whatever balance of reserve for unexpired risk is there in the beginning, that will be transferred to the credit side of revenue account. So that is why this entry you are going to pass. Reserve for unexpired risk account debit to revenue account. So 30, 30 for marine, 40, 40 for this, 10, 10, 10. That means opening balance. Only 2 entries are required. Reserve for unexpired risk account debit to revenue account. Now, at the end of the year, when we create reserve, what happens actually? Our current year's income falls. So that is the reason now I will write revenue account debit to reserve for unexpired. So closing balances of reserve for unexpired risk I will take into account. These 2 entries I will pass. And now I am going to prepare the ledger account. Preparation of ledger account is very simple. All you have to do is you simply write here reserve for unexpired risk. First of all, opening balances are given to you. You simply write the opening balance. Now, according to this entry, according to this entry, you write these items on the credit side. According to this entry, you write these items on the debit side. And now you are going to get what we call closing balances. Section 3, this particular question is also very, very vital in the examination. Many a time I see actually student actually skip it a bit. Is it clear to you? So this is all about general insurance. Hello and great welcome. So as far as this quick revision series is concerned, now in this particular session, quickly we are going to revise all the concepts with respect to your life insurance. Honestly speaking, in comparison to general insurance, we find with great regularity actually questions are striking from life insurance, correct? However, both are important, don't worry about that. So first of all, life insurance, it covers the risk of life of a person. I need not require to talk about this. And importantly, we come straight to the accounting aspects. As you know, under this actually we are supposed to prepare, generally question asks us to prepare a valuation balance sheet, distributable surplus. And there may be a question wherein you may have to compute bonus in cash or reversionary bonus. Generally, questions are related to first 2 part, but question can be asked also with respect to calculation of bonus in cash or reversionary bonus. In order to actually compute, first of all, as I told you, we have to compute the life fund. In order to compute the life fund, actually in the examination you will never be asked to compute life fund because it will always be given. But just to make the point how life fund is computed. An insurance company, like a normal company, also prepares the profit and loss account. So whatever incomes are there, it writes it on the credit side. Whatever expenses are there, it is going to put on the debit side. In case if there are last year's surplus, it is also going to be put on the credit side. In simple words, the difference of income and expenditure is not known as profit in case of life insurance company. It is considered as life fund. And this amount will always be given in the question to you. You will never be asked to compute that. However, how to prepare the valuation balance sheet, because you will have to prepare it. Actually, it is written valuation balance sheet. Actuaries actually prepare the balance sheet. Whatever life fund is given in the question, you are going to put it on the credit side. Then net liabilities. will be put on the debit side. This difference is known as surplus. Is it clear to you? Coming over to the distributable surplus. In order to find out distributable surplus, whatever surplus which you have got through what we call your valuation balance sheet, you are going to write here. In case if in the question it is given that in the current year you have paid, or from last valuation date to the current date, if you have paid in the interim period some interim dividend, you will have to add it. Then generally, this will not be given in question, but just to make the point clear, suppose if it is given in the question, provision for losses. For example, in the question, it is given that company has decided to create a proposed dividend of 1 lakh or to create a provision for investment allowance. In case if there is any, then provision for losses will be subtracted. Provision for losses for investment, or if it is given some amount is proposed, you will subtract it. Correct? Now you will get this amount. Of course, this is your surplus, but this surplus, sometime director decide to carry forward. So if it is given in the question that some portion of the surplus is to be carried forward, in that case, this amount will become your distributable surplus. That means directors have decided that this much amount we are going to distribute. Now, as far as distribution is concerned, just to make the point clear, correct, how to distribute the amount? Actually, there are two major parties. One, shareholders in an insurance company, and another one is policy holders. So that is the reason shareholder will get only at the rate of 5%. Correct? You will compute 5% of this amount, and that part of the distributable surplus will be given to the shareholder. However, 95% of distributable surplus will be given to the policy holder. But policy holders have already received the interim bonus. Bonus is always given to the policy holder. So because you have already added it here, now you will subtract it here to know what amount is due to the policy holders. Is it clear to you or not? Just to make the point clear. For example, on 1/1/2023 and 31/12/2023 is the accounting year, and it is given balance brought forward surplus is given in the question, let us say 9 lakh. Interim bonus paid is given 150. Also, you are given life fund at the end of the year is 90 lakh. Correct? And net liability is 75 lakh. And directors decided to carry forward 10 lakh. So simple, all you have to do, first of all, prepare valuation balance sheet. You write the what we call life fund here. You write the net liability here. Now you have computed 15 lakh. Now, distributable surplus. In order to compute the distributable surplus, take the surplus here, add the interim bonus. Correct? I've already told you provision for losses or amount transferred to proposed dividend will not be given to you. So 16 lakh 50,000. Now you simply carry forward amount because it is given in the question. Directors decided to carry forward 10 lakh. You subtract 10 lakh. Now 6 lakh 50,000. 6 lakh 50,000 is the amount meant for distribution. Now how to distribute it? 6 lakh 50, 5% to the shareholders. 95% 6 lakh 17,500 to policyholders, but you subtract interim bonus, so amount due is equal to 4 lakh 67,500. Now some of you may say, sir, here balance brought forward is given. What is the relevance of this? Sometime in the question you may be given balance brought forward. In such questions you may be asked, besides valuation of balance sheet and distribution of surplus, you may be asked to find out net profit. In order to find out net profit, all you have to do is to repeat the process. Write the surplus, add the interim bonus. If there are losses, till up to this point everything is same. Now all you have to do is simply subtract the surplus brought forward. So you will get the net profit, or you can also get the net profit in this manner also. You can distributable surplus is 9 lakh 50. You simply add opening balance of surplus. Correct? So you subtract it, you will get a negative figure, and now you subtract carry forward, and still you can get the net profit. But I think this approach is better. You better go by this approach. Is it clear to you? In case a question asks to find out the net profit, you can do so. So these are the questions actually from this particular topic, and that is how you have to move about as far as this particular chapter is concerned. There is nothing more in this particular question, to be very honest with you, but just to make the point clear, well, now let us say it is given that on 1/4/2022 and 31/3/2023, interim bonus is 25 lakh. At the end of the year, life fund is this much. And life fund, just sometime in order to confuse you, they may give you life fund in the beginning. You need to consider it quite well in your mind that only the life fund existing on the last day of the balance sheet will be considered. We are not concerned with this life fund. We are concerned with the life fund at the end of the year. We are also given net liabilities. Correct? Besides, in this question, you are given this information also, that total business of the company is 600 lakh. Further, it is given total worth of policies issued 600 lakh, and some cash bonus and reversionary bonus is also information is also given. Now let me just go through this question. First of all, life fund is given. Subtract the net liability, you will get the surplus. Till up to this point, no problem. Write the surplus, add the interim bonus, subtract provision for losses and proposed dividend. In case if there are any, it is 100, no carry forward is there, so your 100 will be considered as distributable surplus. Distribution: shareholders will get 5, policyholder will get 95% of 195, subtract interim bonus, so they will get 75. The important point in this particular question is, it is given in the question total business is for 600 lakh. What does it mean? It means company has issued 600 lakhs worth of policy. Further, it was given in the question that 3/5 of the policyholder decided to receive cash bonus. So first you compute 3/5 of 600, which comes to 360. Indirectly, it means the balance of the policyholder, 2/5 of 600, they are not going for cash bonus. Indirectly, it means they are going for reversionary bonus. Is it clear to you? So now you have segregated it, how much of the policyholders are interested in cash bonus and how much policyholders are interested in reversionary bonus. After that, it will always be given. In the question, it is given that cash bonus is 105 for 1000. That means for every 1000 of policy, cash bonus is 105. So for 360 lakh worth of policy, the cash bonus will be equal to 37.8 lakh. So you will be asked to compute the cash bonus and reversionary bonus. Similarly, rate of reversionary bonus will be given in the question, and generally the rate of reversionary bonus happens to be higher than the cash bonus. It is given in the question 185. That means on a policy of 1000, you are going to receive a reversionary bonus of 185. So on 1,185, so on 240 lakhs, it will be equal to 25 lakh 20. So in case if the question asks you to compute the cash bonus and reversionary bonus, you can compute it. Also, I have given you entries. The entries will be profit and loss account debit to bonus in cash account, and profit and loss account debit to reversionary bonus. But reversionary bonus is not paid to the shareholders. It is adjusted against their future, what we call payments. So that is why this reversionary bonus, because ultimately it will not be an expense. So that is why it will be retransferred to the life fund. So your entry will be reversionary bonus account debit to life fund. So this is we have as far as life insurance is concerned. Is it clear to you or not? So in this revision series, now we are going to pick up today this particular chapter, that is accounting for electricity company. Now, if you remember, in our regular classes, we always start off this particular fact that during earlier times, especially prior to 2002, the electricity domain was completely in the hands of the government. And at the time, public used to encounter and confront lots of problems. And there were lots of public grievances actually which left unaddressed. So in order to overcome that, government decided that we should actually bring in participation of the private entities. As we see nowadays, actually there are lots of what we call private companies. And lots of public grievances which we used to face earlier now no more exist. So that was the basic idea. So now, Electricity Act 2003, the first thing which you need to understand is that it replaced what we call all these acts. From your MCQ point of view, you should be aware of this. It replaced Indian Electricity Act of 1910, as I told you, and besides that 1948, 1956 and 1998. And as I told you, the basic objective is to completely take off the comprehensive control of the government. The objective of the revised act was to distance the state electricity board from the tariff determination, correct? And to invite and bring in participation, especially of the private entities, to reduce the government subsidies, because earlier, prior to 2002, government used to give lots of subsidies. So government no more want to actually provide the subsidies. In fact, government want to actually increase the competition, and government wants actually that electricity companies should become self-reliant and to increase the competition. That was the basic idea. Regarding this particular point from your objective perspective, you need to understand that no license is required for power generation. If suppose you want to generate the power, you need to require to procure any license. But license is required to transfer the electricity, to distribute the electricity, or trading of electricity. Is it clear to you? For that you require what we call generation. For that you require what we call license. However, for generation of the electricity company, you need to require to have what we call any license. Is it clear to you? Now, these are the three main authorities under this particular chapter. One is Central Electricity Authority, CEA, Central Electricity Regulatory Commission, CERC, and State Electricity Regulatory Authority, SERC. As far as tariff is concerned, although authority play an important role and they allow the electricity company to have a reasonable rate of return, but still some leeway is given to the electricity company to determine their own tariff. Tariff means the amount which they are going to charge. These are the things which we discussed in our regular classes, especially with respect to the theoretical portion. Now coming over to your practical portion. The first topic is related to security deposit. You may get a what we call question or 2 marks. Now, in order to comprehend this, we presume that our accounting year is starting on this particular date, 1/4/2021, and ending on 31st/3/2022. Everything will have to be seen and visualized from the perspective of the electricity company. You further presume that your electricity company received a security deposit of say 2 lakh. Obviously, when I want to actually install an electricity meter, I need to actually deposit some amount with the electricity company, isn't it or not? So your electricity company received a deposit, but you received the deposit on 1/7/2021. Is it clear to you? So still there are 6 months period is there. In fact, 9 months period is there till the end of the accounting year. Accounting year is starting on 1/4/2021, ending on 31st/3/2022. You receive the what we call deposit on 1/7/2021. Now, what will happen? When you are the electricity company, we presume that your name of your electricity company is Great Power. So, in the books of the electricity company, I am going to write the entry on 1/7/2021. Because my electricity company received the deposit, I am going to write bank account debit to security deposit account. Obviously, because we have received the deposit from the customer or the consumer, now, because it is a deposit amount, so we are supposed to pay to the consumer what we call interest, because interest has accrued to him from 1/7/2021 till 31st/3/2022 for 9 months interest. You means the electricity company is supposed to provide him. Now, your entry will be interest expense account debit to interest accrued on security deposit account. How you are going to compute the amount of interest? The deposit amount is 2 lakh, 8%. Now, this percent will always be given to you. For example, in this particular question, you will be given that on 1/4/2021 accounting year is starting ending on 31st/3/2022, and on this date, RBI rate is 8%. That means you are going to apply the rate of interest which is prevailing in the beginning of that accounting year. Correct? So in the beginning, the rate which is prevailing as per RBI is 8%. So you are going to apply 8% for 9 months. Now, interest is an expense for electricity company. You are going to debit interest expense account. And of course, interest accrued is a liability because you are supposed to pay 12,000. Now, the point is that, which I told you in my regular classes, that we are not going to make the payment regarding the interest, although we are supposed to make the payment. Why? Because during these 6 months, we have supplied electricity to that particular consumer. Obviously, now electricity company is supposed to receive some electricity bill, and we are supposed to pay him interest, and we are supposed to receive some electricity bill. So what we are going to do now, this interest which we were supposed to pay to that particular consumer now will be debited, and we are going to write electricity sale account. Indirectly, it means whatever the bill was there, that bill will get reduced by that interest which the electricity company was supposed to pay him. Is it clear to you? Suppose electricity bill was 1,12,000. Now consumer will subtract 12,000 and he will pay it only 1 lakh to the electricity company. So that is why this entry is passed, interest accrued on security deposit account debit to electricity sale account. Is it clear to you or not? Second point which we had a discussion in our what we call regular classes was with respect to what we call service line development charges, also known as customer contribution towards service lanes. Now, in order to have a better what we call facility regarding the what we call electricity, or better what we call infrastructure with respect to the electricity company, so often we see actually that electricity company, in order to develop your area, sometime they charge what we call some amount to develop that particular area. So that means the consumers are supposed to actually donate or or donate or give some amount to the electricity company for development of that particular area or service lanes. That is why it is known as service lane development charges, also known as SLD charges. Is it clear to you? Or indirectly, it is also known as consumers' contribution towards service lines. No doubt, when consumers are going to contribute for the development of the service lines, this electricity company is supposed to receive some amount. Let us say there is an electricity company, it wants to actually develop that particular area by taking a project of 500 crores, correct? That means capital expenditure is 500 crore. Electricity company has decided that we are going to develop this particular area. So we may have to spend actually nearly 500 crores worth of amount. Now, the point is that, let us say in the question it is given that 40% is consumers' contribution. That means out of 500 which electricity company is going to spend, 40% will be contributed by the consumer. That means 40% of 500 will be equal to 200, isn't it? So, in the books of the electricity company, your first entry will be capital expenditure account debit to bank account, because you are the electricity company and you have paid 500 rupees. Is it clear to you? Now you are going to receive what we call the contribution. How much will be the contribution? It is given 40%. So 40% of 500, that means at least you will get a recovery of 200 crores. So bank account debit, you can simply write to SLD charges or consumer contribution, whatever you may feel relaxed about. Is it clear to you? So bank account debit to SLD charges account. SLD means service lines development charges, or consumer contribution account. So 200 you have recovered. Now the point is that it is an income for you. No doubt about that. Because your expenditure was 500, now you recovered 200. So quite obviously it is an income. Now the question is that, are you going to transfer this income in the first year itself to the profit or loss account? No. You will find, let us say this capital expenditure is meant for 10 years. So as per the life of the capital expenditure, you are going to transfer every year some portion of SLD charges which your company has received to the profit or loss account. Because in this case, 200 is the amount and 10 year is the life. So each year you are going to transfer 20 crores to the profit or loss account. So your next entry will be SLD charges account debit or consumer contribution account debit to profit or loss account. That means for next 10 years, you are going to repeat this entry. Is it clear to you? Simple. Hardly 2-mark question you can have from this particular topic. If you remember in the next part, we had a discussion with respect to grants. Generally, you can simply say grants are two types. Grant could be given as an incentive, or grant could be given to meet the capital expenditure. Now, if grant is given as an incentive, I will let you know what we mean by incentive here. In that case, your first entry will be bank account debit to grant account. And obviously, because you have received this grant, you are a particular electricity company and you have received some grant from the government. So bank account debit to grant account, obviously you are going to transfer it to profit and loss account, and straight away you are going to take it to the profit and loss account. That means if grant is meant as an incentive, in that particular case, in the year in which you are going to receive the grant, in the same year, actually, you are going to transfer it to your profit or loss account. Is it clear to you or not? Now, I will give you an example to elaborate it. For example, there is a company by the name of Kingfisher Power Limited. We further presume that this company incurred cash losses of 1,000 lakh. It's a huge loss. But government wants this particular company to keep on functioning, to keep on operating. So government comes to the rescue of this particular company and government provided 50% to meet their losses. Now total loss was 1,000 and government has decided to provide 50%. Indirectly, it is an incentive to the Kingfisher that you keep on operating. That is why this grant will be considered as an incentive. So in this case, your entry will be bank account debit to grant account, 50% of 1,500. And then immediately, you are going to take this amount of grant to the profit and loss account. In case of incentive, immediately you are going to take the amount of grant to the profit or loss account. Is it clear to you? However, if grant is meant to meet the capital expenditure, in that particular case, similar to the consumer contribution, as per the life of the project, you are going to transfer every year some amount to the profit or loss account. That's the basic difference. First, you are going to pass the entry for incurring the capital expenditure, then you are going to receive the grant, and then some portion of the grant will be transferred to profit or loss account. but not full amount. Is it clear to you? In case of when grant is given to meet capital expenditure. To elaborate this point, let us say there is an electricity company and it is undertaking a big project cost. Is it clear to you? That means it is installing a transformer, it is installing a big electricity, what we call power plant or whatever it might be. So when we say project cost, it means indirectly electricity company is what we call installing a big power project. Is it clear to you? Now, electricity company, because cost of the project is 100, obviously this cost will have to be borne by the electricity company. So this is the capital expenditure for the electricity company. Electricity company will write the entry capital expenditure account debit to bank account. Is it clear to you or not? Now, we further presume that out of this project cost of 100, 40% was received by the electricity company as consumer contribution, and 25% is received as grant from the government. Now this time this grant will be considered as grant for meeting the capital expenditure, and rest of the amount obviously will have to be borne by the electricity company. Now the point is that 40% has been received as consumer contribution. So 40% of 100 will be 40, and as I told you, we further presume that life of this project is 10 years. Correct? 10 years is the life of this particular project. So whatever consumer contribution is received, I will divide it by 10, and each year 4 lakh will be transferred to P&L. And similarly, as far as grant is concerned, 25% of 100, 25 crores is the what we call amount of grant. And because life of the project is 10 years, so every year I am going to take 2.5 to the what we call P&L account. So this is how you are going to pass the entry. First entry will be for capital expenditure, which the electricity company will have to incur. And then you are going to receive 40 lakh as consumer contribution. You are going to receive 25 lakh as grant amount, total amount 65, which your electricity company has received. And obviously it will be considered as an income for the electricity company. And they are going to transfer it to profit or loss account. As I told you, at the end of the first year, only 4 lakh out of 40 and 2.5 out of 25 will be transferred to profit or loss account. Total 6.50 will be transferred. Is it clear to you or not? Clear? Okay. Now, there was another topic in this particular question with respect to what we call depreciation, if you remember. I told you, as far as electricity companies are concerned, it is regulated by Regulation 2009. Correct? That means, as per the rates which are given by Central Electricity Regulatory Council, you are going to actually charge the depreciation. The important rule is that depreciation will be charged by the electricity company as per SLM. You cannot use any other method. That means straight line method will be used. Number one. And salvage value at least 10% shall be considered. Although if you are in electricity company, you can consider 20%. But at least 10% should be considered. It means if in the question no salvage value is given, you will still consider salvage value as 10%. Is it clear to you? These are the two vital points. And depreciation obviously will be provided on time proportion, and you will start providing depreciation when project is put to use. Simultaneously, there was another concept of advanced against depreciation. And this was the concept which I talked a lot at great length in my regular classes, because many people do not know the correct what we call treatment and what exactly this means, because they are still what we call in the dark. So I tell you once again, we presume that cost or capital expenditure is 500. Let us say an electricity company is there and it is undertaking a project and the project cost is 500. We further presume that life of this particular asset or project is 15 years. In this question, it is given that this project cost of 500 is financed 70% by the loan. Finance 70% by the loan, what does it mean? That means if project cost is 500, then you have taken a loan also, and the amount of loan will be equal to 70%, that is equal to 350. Isn't it or not? And further it is given that repayment of this loan is in 10 years. Because loan amount is 350 and every year, and within next 10 years you are supposed to repay it. Indirectly it means actually every year 35 lakhs worth of what we call loan repayment must be done. Is it clear? Is it clear to you? Now, if I am going to ask you calculate the amount of depreciation in this particular case under normal fashion, how you are going to compute? It is very simple. First of all, you are going to have a look over the what we call cost of the asset or the project, 500. Just a moment ago, I told you under electricity, if salvage value is not given, still at least 10% salvage value will be considered. So no salvage value is given, still you are going to consider that salvage value will be 10%, that is 10% of 550. Now this 450 is in accounting jargon, we call it depreciable amount. That means total depreciation which you must provide must be equal to 450. This 450 is nothing but the total depreciation which you need to provide. Now the question is, under normal circumstances, my depreciation amount would have been, because the life of the asset is given as 15, so 450 divided by 15, so depreciation per year under normal circumstances would be 30. Is it clear to you or not? Correct? Okay. Now just have a look. Because in this case, this project cost has been financed through a loan which I just talked about, and the loan amount is 350, and loan must be repaid within 10 years, not 15. Loan has to be repaid in 10 years. So if you divide it by 10, it means every year your loan installment is equal to 35 lakh. Now the question is, how much depreciation you are going to provide each year? Now see here, total life is 15. I have written here 1, 2, 3, 4, 5, 6 till up to 15. Now loan repayment in the first year will be 35, in the second year 35, and so on. So till up to first 10 years you are going to make a payment of 35. As I told you, your normal depreciation which we computed, correct? Here we computed normal depreciation, 450 divided by 15 is equal to 30 lakh. Actually, my normal depreciation is 30, 30, 30. No doubt about that. This is my 30, 30, 30 is the normal depreciation for first 15 years till the life. Correct? But if an asset has been financed through a loan, in that case, the Electricity Act states that amount of depreciation must be equal to the loan installment. Now, because your loan installment is 35, so you are not going to charge your normal depreciation. Rather, in the first year, your total depreciation will be equal to 35. That means in the first 10 years, you are going to charge depreciation at the rate of 35. In the first 10 years, you are going to charge depreciation at the rate of 35. Although your normal depreciation in the first 10 years is equal to 30. No, you are going to charge 35. It means in the first 10 years, you are charging 5 lakhs worth of depreciation extra. This extra depreciation is known as advanced against depreciation. Is it clear to you? This is known as advanced against depreciation. Now the question is, in the first 10 years, you have already charged a depreciation at the rate of 35. Now, I told you total depreciation which you are supposed to charge is equal to 450. Total depreciation we are supposed to charge is 450. Out of that, in the first 10 years, we have charged depreciation equal to 350, 35 into 10. So that means 100 worth of depreciation still need to be charged. So that means in the next 5 years, that means from 11 to 15, in the next 5 years, I will have to charge a depreciation of 20. So that is why in the 11th year, 12th year, 13th year, 14th year, and 15th year, I am going to charge a depreciation at the rate of 20. So this is known as optimized depreciation. And this 5 lakh will be known as advance against depreciation. I hope you got this particular point, which we had a discussion a lot in the class. Next point, debt equity ratio. What does it mean? Electricity Act says that whenever an undertaking company is going to take a big project, then at least 70% financing should be from debt. And 30% must be through your own sources, that is equity. Is it clear to you? That means if you are an electricity company, you are going to undertake a project, 70% will be through debt and 30% should be through equity. Is it clear? Fine. I also told you how an electricity company fixes the price when you receive the electricity bill. What is the per unit charge? And remember one thing, when we use the word charge, in case of electricity company, we, instead of using the charge, we use the word what we call tariff. It includes the profit margin also, obviously. Now, in order to make you understand, let us say there is an electricity company and cost of the project is 200. Obviously, 70% is financed through debts, as I told you. So 30% will be financed through equity. And debt interest is 12%. Is it clear? As I told you, loan amount is 140. And because life of the asset is 10 years, or let us say this debt has to be repaid in 10 years. This debt has to be repaid in 10 years, we presume. So that means 140 is the amount of loan and 10 is the what we call repayment period. So each year I need to actually make a loan installment of 14. That means every year I am supposed to pay 14 lakhs to the financial institution from whom actually we have procured the amount of loan. Now, my question is, what would have been my normal depreciation? Because my cost is 200 and salvage value is not given, 99% it will never be given. So you are going to consider 10% as the salvage value. So your 180 will become the total depreciation. That is why it is known as depreciable amount. So this much of depreciation you are supposed to provide. But because project life is, we presume that project life is 15 years, correct? So I divided by 15. So under normal circumstances, my depreciation would have been 12. But because here the financing has been done 70% through loan. So whenever financing will be done through loan, in that case, you cannot actually go for the normal depreciation. You will have to compute the optimized depreciation. So for that, what you are supposed to do? You need to just think of what your loan amount 140 and its repayment period 10. That means every year your loan installment is 14. And your normal depreciation is 12. That means advance against depreciation is 2. So optimized depreciation will be 14 because amount of depreciation must be equal to the loan amount. Normal depreciation is 12. So every year you need to charge 2 lakh extra. Is it clear? Total depreciable amount is 180, 200 minus salvage value. Out of that, of course, 180 depreciation we need to charge in 15 years. But in the first 10 years, we would have had charged what we call depreciation of 140. Because each year in the first 10 years, we are going to charge depreciation at the rate of 14. So 14 into 10, in the first 10 year, total depreciation charged will be equal to 140. 140 minus 80 will be equal to 40. That means from 11 to 15th year, in the next 5 years, I need to charge only 40 as depreciation. 40 divided by 5 will be equal to 8 lakhs per year. Is it clear? Now, because you have financed this particular project through a loan and the rate of interest of loan is 12%. So at the end of the first year, how much interest you are going to pay? 140 lakh into 12%, 16.80. Now but at the end of the first year, you are also going to make a payment of 14 lakh loan installment. That means when your second year begins, your opening balance of loan will be equal to 140 minus 40 because you have paid the installment. So when you are going to compute the rate of interest for the second year, it will be 140 minus 14 into 12% and so on. Is it clear to you? Now, how tariff is computed? We presume that this electricity company has some fixed expenditure in electricity generation, distribution and other charges in year 1, in year 2, in year 3, 4 till up to year 10 and till up to year 15 also. That means each year we have to spend 50 crores or 50 lakhs, whatever it is. Is it clear to you? On electricity generation, distribution and other charges. Now, you see, in this case, your interest on loan in the first year, as I computed, was 16.80 in the second year. And likewise, in the 10th year, it will be equal to 1.68. Correct? But in the 11th year, in the 12th year, in the 13th year, in the 14th year, and in the 15th year, there will be no interest. Because loan has exhausted after the 10th year. Now, as far as depreciation is concerned, depreciation will remain same for the first 10 years. First year, second year, 10th year. But depreciation will be charged at the rate of 8 from 11 to 15th year, as I just told you. So total cost in the first 10 years for the first year will be equal to this much, for the second year will be equal to this much, and just to make the point clear, I have written also 10th year. If your total cost is 80.80, Now, Electricity Act says that whatever your equity is there, at the rate of 14% on equity, you can have a reasonable profit. So this 14% should be what we call remembered by you. So return, that means what will be your profit? This is your cost in the first year. So 14% of equity, we have already seen equity is 60 lakh. So 14% of 60 will be equal to 8.40. So you are going to charge a tariff at the rate of 89.20. Similarly in the second year also, similarly in the third year, and similarly in the final year. That is how the what we call tariff is determined by the electricity company. Besides that, there were some questions which are very important from the examination point of view. Especially questions related to return on equity, like question number 6, 7, 8, 9. These are important questions. Just to make the point, under such questions, you will be given like this. There is an electricity company, its approved opening capital cost. That means total capital cost. Obviously, when an electricity company undertakes a project, it has to get what we call approval from the government. So anyway, so your opening capital cost is 75 lakh. Then it is some information is given like this, that in the year 2000, your opening capital on 1/4/2012, then in 2013 you spent some additional capital. Similarly in 2014, in 2015, in 2016 also. Correct? This is additional capital expenditure. Now only this much of information is given, and you are supposed to compute return on equity. How we are going to compute? See here. First of all, I am going to write here my opening equity. Now, because this is my opening capital expenditure. Now, could you tell me what would be your opening equity? I just told you your total expenditure must comprise of 70% in the debts, 30% in equity. So you simply compute 30% of 75 lakh. So you can say your opening equity is 22 lakh 50,000. Correct? 30% of opening equity. Similarly, now additional expenditure. This is your additional expenditure in 2013. Correct? So out of this additional expenditure, 30% must be equity. So additional equity, you simply add it. So your opening equity is 22 lakh 50. And additional equity which you have computed 5 lakh into 30%, 150. So your closing equity will be equal to 24 lakh. Is it clear to you? Now opening equity is given to you. Closing equity you have computed. So you compute now average equity. Average equity will be 23 lakh 25,000. Now you simply apply 14%. This is how you are going to compute the return on equity. These are the major questions which have been asked so often in the examinations. Similarly, now coming over to the next year, remember one thing, this opening equity will become this closing equity will become the opening equity for the next year. Now in the next year, your additional capital expenditure was 1 lakh 50. You compute 35% of that. That will give you additional equity. Now you add additional equity, you get closing equity. Once you have the closing equity and opening, you can compute the average. Simply apply 14% to get what we call return on capital. All these questions, 6, 7, 8, 9 belong to same category. Is it clear to you or not? Beside, there was a question, actually this is question number 9, I have written 13, but this is question number 9. Now, in this particular question, what we are supposed to do? Here we are being asked to compute average cost, return on equity, interest on loan, and advanced against depreciation. We are being asked to compute average cost, return on equity, interest on capital, and advanced against depreciation. Information is given that on 1/4/2022, 10 lakh is the opening capital cost, that means capital expenditure. This time we are being given weighted average rate of depreciation 5.20, and some further information is given to you. Your additional expenditure in the year 22-23 and 23-24, 70 and 20. Repayment of loan is also given 60,000, 70,000. Weighted average rate of interest on loan is also given. Now under such question, what you are supposed to do? See here. First of all, you are going to write the opening capital employed, that is 10 lakh, 10 lakh 70. How I have computed it is given in the question, that your opening capital employed is 10 lakh. First you write 10 lakh. Now, capital expenditure. Remember one thing. Here I need not require to take 30% because at this moment I am trying to find out average cost. because question has asked us to compute the average capital expenditure. So I will take the full amount of additional expenditure 70. So closing cost or closing capital expenditure will be 10 lakh 70. Now you take the average of these two, you will get the average capital expenditure. So average capital expenditure will be equal to this much. Now this closing will become the opening, and in the next year your capital expenditure was 20, you add it, you get the closing and get the average. So our first target is over. We had to compute the average cost, we found out, and now question has also asked us to compute the return on equity. Just a moment ago we saw actually how the return on equity is computed. We need to have average equity, isn't it? Now we can directly compute average equity because we have average capital expenditure. I can directly take 30% of that. It will tell me average equity. I will have to apply 14% to get return on equity. Similarly, I will take 30% of 10 lakh 80. That will deliver me average equity, and I will apply 14%. Return on equity is also over. Now, the main point is calculation of depreciation and advanced against depreciation. Depreciation is always charged on the cost of the capital, isn't it? Now, in this case, average capital expenditure you have already computed. 10 lakh 35 and 10 lakh 80. Correct? Whenever weighted average rate of depreciation is given, you simply apply these percentages. You can get the normal depreciation straight away. Is it clear to you? In order to compute the normal depreciation, you simply apply the weighted average rate of depreciation on average capital employed. This rate is given in the question. So you have the depreciation. Now the point is that you have to compute optimized depreciation and advanced against depreciation. Because in this question it is given that you have taken a loan, and in the first year repayment of loan is 60,000. That means loan installment is 60 in this, and in the next year it is 70,000. So it means your normal depreciation is 53,820, whereas your loan repayment is 60. So difference of these two will be your advanced against depreciation. Similarly, you can compute the advance against depreciation as 13,840. Is it clear? Another point. In this question, you are being asked to compute interest on loan also. Now, first of all, you write the opening balance of loan. Because your opening capital cost is 10 lakh, so 70% must be debt financing. So 70% of opening capital employed, opening capital expenditure 7 lakh, first of all you write. Here I have written repayment of loan because this is my first year, no question of repayment. By subtracting repayment from the opening, I get net opening loan. So net opening loan you need to compute, that is 7 lakh. Now, I need to add here additional loan because their additional capital expenditure was given in the question. So I will take 70% of that and add here. So by adding the additional capital expenditure to the net opening loan, and by subtracting the what we call repayment of loan, because at the end of the year I'm supposed to pay 60,000. So I will be left up with closing loan. So net opening loan and closing loan, now you take the average, and now because the rate of interest is given, so you apply the rate of interest to this and you can get the interest on loan. Now this closing loan will become the opening loan. However, at the end of the first year, you have made a payment of 60,000, you subtract that, so your net opening loan will be considered 6,29,000. You add the additional loan, you subtract 70,000, because in the current year you are going to pay 70,000 worth of installments, so your closing loan will be equal to this much. Now you take the average of these two, it will be equal to 6,01,000. You apply the weighted average rate of interest, you will get this figure. So this is how you are supposed to do this particular chapter in a very comprehensive manner. Almost full chapter I have done here. Is it clear to you? In spite of the fact that it is revision series. So shall meet you after 5 minutes. Hello and great welcome. So now in this particular session, we are going to take a quick look over what we call financial statements. Another important chapter, no doubt about it, but not very tough one. As you know, under this particular chapter, we used to prepare what we call profit and loss statement for the year ended. And in order to prepare the same, first of all, we used to write revenue from operation. And generally revenue from operation includes sale only, sale of product, but it also includes sale of services. And in case if in the question it is given other operating revenues, you will have to include it. Is it clear to you? Sometime you may be given excise duty. In case if it is given, you will subtract it from sales to arrive over revenue from operation. Then we will write other income like rent received, like dividend received, like any transfer fee received, any interest received. All these are considered as other income. Then by totaling the same, we will get the total revenue. And from the total revenue, we are going to subtract various expenses. The first component of the expense used to be what we call cost of purchase. Generally, under cost of purchases, we simply write purchases less purchase return. But here one important point is that in case if in the question opening and closing stock of raw material is given, so in that case, in order to compute the cost of purchases, you will write the opening stock of raw material. Then you are going to obviously add here net purchase of raw material. Then subtract the closing stock of raw material to find out cost of purchases. If opening and closing stock of raw materials are not given, in that case, straightway you can write purchases less returns. Then changes in inventory, you simply what we call take the opening stock and subtract thereon from what we call closing stock. Suppose your opening stock is 1 lakh and closing stock is 90,000. So there is positive figure, you write the positive figure. And suppose opening stock is 90 and closing stock is 1 lakh, then it will be a negative figure. Is it clear to you or not? Then after that, we take into account employee benefit expenses like wages, salaries, employee staff, employee security, insurance, employees provident fund, staff welfare expense, canteen expense, director fee, remuneration, etc. Similarly, finance cost, any interest paid on bank loan, interest on debenture. In case if there is given any net loss or gain on foreign currency translation, you will also adjust it over here. Correct? Then we write depreciation and amortization, and then other expenses. When we write other expenses, means all such expenses which we haven't included under the first 4 categories, like advertisement, discount, general expenses, rent, auditors expense, carriage outward, repairs, power, fuel, insurance. Importantly, if bad debts is given in the trial balance, you will write here plus. Then similarly, provision for doubtful debts is given in the trial balance, you will write it here as a negative item, less provision for doubtful debts as per trial balance. However, bad debts as per adjustment and provision as per adjustment will be added back. Is it clear to you? Bad debts as per adjustment and provision for doubtful debts as per adjustment will be added back. Then we will get the total expenses. We are going to subtract the total expenses from the total revenue to get profit before tax. And from there on, we are going to subtract the tax expenses. And tax expense, generally, because this information is generally given in the adjustment. Is it clear to you? So whatever rate of provision is given, we are going to apply that rate to this amount, and we will get the provision for tax, and then we will get profit for the period. After that, we generally prepare a statement of surplus. In the statement of surplus, if in the trial balance there is some balance of P&L is given, you will write here. If P&L balance exists in the trial balance, then this net profit which you have arrived at will be written over here. And in the additional information, if there is some information regarding what we call transfer to general reserve or to interim dividend, you are going to write over here, and then finally you are going to get the balance carried down, which will be written in the balance sheet. Is it clear to you? Then we prepare the balance sheet. This is what we used to do. For example, just to have a look over this particular question. For example, equity share capital is given. You are going to write it under balance sheet, under share capital. General reserve, if it is given in the trial balance, then simply you will have to write it under reserve and surplus in the balance sheet. Now, profit and loss account credit balance is given. You are simply going to take it, as I told you, to the statement of surplus and write their balance brought down. Debentures in the liability side, you are going to write under non-current liability. Now, motor vehicles, motor vans, machinery, buildings are given to you. If there is some depreciation, you calculate the depreciation and then write what we call motor vehicles, machinery, buildings in the balance sheet. And depreciation, of course, will be written in the profit and loss account, profit and loss statement. 12% long-term government securities is given. It means you have invested the amount because it is given in the debit side. So you are going to write it in your asset side under what we call non-current assets, non-current investment. Is it clear to you? 2 lakh. Sales revenue from operation. Sorry, extremely. Then you are being given here sales return. Sales return you are going to subtract from the sales. Interest on debenture will be written what we call, as I told you, in the under the financing expenses. Correct? Purchases, you are going to write here under cost of purchases in the P&L account. Purchases return you are going to subtract from purchases. Then opening stock is given. I told you opening stock minus closing stock, and then you are going to write it as change in inventories. Discount allowed will be written under other expenses. Carriage outward under other expenses. Rent and rates other expenses. Income from government securities. Now kindly pay attention. Because you have invested in government securities to the extent of 2 lakh. So if you are going to compute 12% of 2 lakh, that comes to 24,000. So that means whatever income which you were supposed to receive in the current you have received. Is it clear to you? This interest will be written under other income. Correct? When we write what we call revenue from operation, then below that we write what we call other income. So under the other income, you are going to write interest received. Then trade receivables are given. Trade receivable, obviously in the balance sheet you are going to write. Then trade payable, your current liability, advertisement expenses, other charges, bad debts appearing in the trial balance, simply you will add it under what we call other expenses. Salaries, employee benefit expense, miscellaneous expenditure, you will take it to the other expenses. Contribution to PF and gratuity fund will be written under employee benefit expense. Cash and bank balance will be written in the balance sheet under current asset. Correct? There is some information with respect to closing stock. As you know, closing stock will be used for computing changes in inventories. From the opening stock, you will subtract the closing stock, but don't forget to write it in under the current asset. Then depreciation, as I told you, you are going to apply. And then don't forget to write depreciation under what we call depreciation and amortization category. Interest on debenture is payable quarterly, and last year interest is yet to be paid. Now, see here you have invested some amount in 10% debentures, 3 lakh. Is it clear to you or not? That is 3 lakh. And question says that some interest on debenture is outstanding. You can compute 3 lakh is your debenture. You apply the what we call rate. And last quarter, a quarter comprises of 3 months. So you can compute the interest on debenture. Is it clear to you? This is how you are going to compute the amount of interest on debenture. So interest on debenture, if you are going to compute, it comes to 22,500. And importantly, this interest which you were supposed to pay, you have already paid because it is given in the balance sheet, interest on debenture. So interest on debenture will be considered as financing cost. I have already told you. Importantly, in this particular question, it is given trade receivables include a sum of 25,000 due from Mr. X, who has become insolvent. So under this question, what you are supposed to do? Under this question, what you are supposed to do, you see here, your total trade receivable given in the trial balance is equal to 10 lakh. Now you segregate, because it is written 25,000 were due from Mr. X. So you you segregate, and rest of the debtors are equal to 9,75,000. Is it clear? Further, it is given that the amount which you were supposed to receive from Mr. X, he has become insolvent. And further it is written, only 25 paisa in a rupee is expected to be recoverable from him. That means you are going to receive only 25% indirectly. You are expecting that you are not going to receive 75%. So first you compute 75% of 25,000. So this much of provision you are supposed to make against these debtors, because you expect that he will not pay 75%. And question says that create a provision for doubtful debts at the rate of 2% or other trade receivable. Now, other trade receivables are 9,75,000. So you simply take 2%. So 2% of 9,75,000 is 19,500. So you can say out of total debts of 10 lakh, 19,500 plus 18,750 will be your provision for doubtful debts. So in the balance sheet, you subtract 28,250 from 10 lakh and write the debtors amount. Number one. And this provision which you are supposed to create, because it is an adjustment, you will have to write it under what we call other charges. Is it clear to you? Provide for income tax. That means once you have computed, once you have subtracted all the expenses from your income, you will get the net profit before tax. Then provide for income tax given 1,50,000. First you subtract, and don't forget to write it under current liability. Last item is important. Directors proposed a dividend of 10%. I have already told you no treatment will be done with respect to with respect to this. Is it clear to you or not? Because as per accounting standard AS4, it is not considered as a liability. So if you are going to solve this particular question, as I told you, so in fact I have solved this question somewhere in detail, so I will also show you so that you have a good idea. Now see here, first I will show you the P&L. Actually, in practical life, balance sheet is made first and then statement of P&L, but it is always better to prepare statement of P&L first. Revenue from operations, sales 60 lakh minus 3 lakh 57. Income from government securities, I told you 24. So your total revenue will be equal to 57 lakh 24,000. Purchases were 36 lakh minus 4 lakh returns. Then changes in inventory, opening stock minus closing stock. 50,000 negative you are going to write here. Employee benefit expense comprise of salaries and contribution to provident fund and gratuity fund 7,72,000. Is it clear to you? Then finance cost, interest on debenture 22,500. But problem is that total expenditure, total interest for the quarter comes to 30,000 and you have paid only 22,500. So 7,500 will be considered as outstanding, and this outstanding must also be presented in the current liability under other current liability. Depreciation and amortization, if you are going to compute the depreciation, it will come to 5 lakh. Then other discount, carriage outward, then rent and rates, bad debts appearing in the trial balance provision, which you have created 38,250, advertisement, miscellaneous expenses, total expenses will be equal to, total other charges will be equal to this. So total expenses you compute, then you take the difference, and then you write your provision for tax, and you must not forget to write this provision for tax in the balance sheet under current liability and provisions. Then statement of surplus. In this particular question, as I told you, it was given that there is an existing balance in the profit or loss account. You are going to write here the net profit for the period also. And in the adjustment, there is an adjustment, transfer 1 lakh to the general reserve. If there is an adjustment with respect to general reserve, you are going to write it over here. And this general reserve will be added to the general reserve which is already existing in the trial balance. Is it clear to you or not? And this will become your closing balance, which you are going to write it under surplus in the balance sheet. This is how your balance sheet will appear. Share capital, then general reserve 2 lakh existing in the balance sheet and 1 lakh which you transferred, so total 3 lakh. And P&L surplus balance, then 10% debentures, then trade payable, interest outstanding, provision for tax. Similarly, in the balance sheet, motor vehicle 4 lakh less depreciation, machinery less depreciation, building less depreciation, then long-term investment you are going to write. Then under current asset, inventories, closing stock, trade receivable, as I told you, 10 lakh minus provision, and then you are going to write the net debtors and then the balance sheet. So this is how you are supposed to do such questions. Is it clear to you or not? This is all as far as financial statement is concerned. Importantly, you need to be very careful regarding the what we call formats. Now coming over to some important question. Okay. These are also very vital questions. For example, question number 6, question number 5. Because often I have seen in the question, actually, instead of asking the full questions, they are simply asking you to prepare the balance sheet. From the following particulars furnished by Pioneer Limited, correct? Prepare the balance sheet. So in this question, you are supposed to prepare only the balance sheet. You are being given equity share capital 10 lakh. Then calls in area, of course, calls in area will have to be subtracted from the equity share capital. Then you are being given land, building and plant and machinery. Further, you are being given here furniture also. Then general reserve is already there. Obviously, general reserve will fall under reserve and surplus. Then loan from finance corporation is 1,50,000. Correct? Now, there we will pick up some what we call adjustment. The first adjustment is that 2,000 equity shares were issued for consideration other than cash. You need not require to do anything. Whatever your equity share capital is there, you write that in the balance sheet, and in the bracket you write this information. Actually, the law wants all the information to be presented very carefully. so that people can get an idea that whatever share capital which you have issued, out of that 2000 shares have been issued for consideration other than cash. Is it clear to you? So when you are going to write equity share capital 10 lakh, you write in bracket, of the above 2000 shares have been issued other than cash. Now, there were calls in area also, so you are going to write this way around 9,99,000. Is it clear? Another information. Trade receivables of 52,000 are due for more than 6 months. Now, in this particular question, your trade receivables are equal to 2 lakh. Actually, law states that if you have trade receivable, then you need to segregate them into other trade receivable and such trade receivables which are due for more than 6 months. So, indirectly, you will have to break it into two parts. How you are going to break it, that I will tell you. Now, see here. When I am going to write the trade receivable, obviously under current asset, I will write it this way: due for more than 6 months 52,000, and balance out of 2 lakh minus 52, balance will be 148. So other debts will be considered as 1,48,000. Is it clear to you or not? This is how trade receivable will be presented. Now, third information. In the third information, you are being given cost of the building is 4 lakh, plant and machinery is 7 lakh, and furniture is 62,500. Now, the point is that if cost of building is 4 lakh, and here building is shown as 3 lakh 50, that means 50,000 depreciation has been charged. So, in the balance sheet, when I am going to write, see here, I am going to first of all write the cost. And then in the trial balance, building was given as 3 lakh 50. Then I will write the difference as balancing figure. Similarly, plant and machinery, I will write the cost, and in the trial balance it is given 525. Difference will be what we call 1,75,000 depreciation. Similarly, you will have to present the what we call furniture. Is it clear to you? Then in the next information, you are given that balance of 1,50,000 in the loan account with State Finance Corporation includes 7,500 for interest accrued but not due. What does it mean? See here, it was given that loan from State Finance Corporation is 1,50,000. Of course, it is secured loan. Now, question says that this loan actually includes interest outstanding to the extent of 7,500. So, what you are going to do, you subtract 7,500 from 150, 1,42,500 will be presented as non-current liability item, and in bracket you can write secured loan, and 7,500 will be presented under current liability. I will show you. See, under the non-current liability I have written secured loan. Loan from State Finance Corporation 1,50,000 minus 7,500. You can also write in brackets secured by hypothecation of plant and machinery because it is given in the question. Now 7,500 will be considered as a part of current liability. Is it clear to you, the interest which is due? Balance of bank includes 2,000 with Perfect Bank, which is not a scheduled bank. Now, as I told you earlier in my regular sessions, that actually company law wants whatever cash balance which you have got need to be broken into two parts. Balance which is available with the what we call scheduled bank, and balance which are not available with the scheduled banks. Your cash at bank is 2,47,000. Now you will have to break it into because question says that 2,000 is with a bank which is not a scheduled bank. So that means 2,000 is with unscheduled bank, and with scheduled bank is 2,45,000. So this is how you are going to reflect the cash at bank. See here, cash at bank, scheduled bank 2,45,000, with other bank that is equal to 2,000. Correct? These are the information. Further, it is given company had contract for erection of machinery 1,50,000. It will not be presented anywhere else. It is considered as a contingent liability. So below the balance sheet in the footnote, you can simply write contingent liability, and you can write this statement that contract for erection of machinery 1,50,000 is still incomplete. Is it clear to you? So this is how you are supposed to do the question. As I told you, equity share capital, calls in area, but in bracket don't forget to write that 2,000 shares have been issued for consideration other than cash. All these three items we have already incorporated, even furniture also. General reserve will come under reserve and surplus. Loan from Finance Corporation, non-current liability 1,42,500, 7,500 will be under what we call current liability. Inventories. Now 2 lakh. Inventory of finished goods 2 lakh, of raw material 50. So total inventory you will write in the balance sheet, but you will write them in a segregated manner. Correct? Then trade receivables, I have just told you, you will have to divide them into two parts, other debts and debts due for more than 6 months. Advances, current asset, dividend payable, current liability, profit or loss, you need not require to write anywhere else because we are supposed to write. However, this time, profit or loss account balance is given, you will have to write it under reserve and surplus. Then cash and bank balance, you will write under balance sheet. Cash at bank, you will have to break it down. Loan unsecured 1,21,000 non-current liability. Trade payable, obviously your current liability. Is it clear to you? Then your balance sheet will appear like this. General reserve 2,10,000, profit or loss account surplus 86,700, secured loan 1,42,500, unsecured loan 1,21,000, current liabilities trade payable 2 lakh, interest accrued but not due 7,500, dividend payable 60,000, provision for tax 68,000. And then non-current asset we have already talked about. Land, then we have what we call building, then plant and machinery, then furniture, then current assets. See here, inventory, how you are supposed to present. You will have to write raw materials and finished goods. Then trade receivable, debts outstanding for a period of 6 months 52, other debts 148. And as far as cash and bank balances are concerned, cash at bank 245 scheduled, unscheduled 2,000, and cash in hand 30,000. And short-term loans and advances are also given in the question. So this is how you are supposed to. These questions are very important. Question number 6 and question number 5. Question number 5 and question number 6 are absolutely on same pattern. So as far as financial statement are concerned, it is very important that you need to be very well versed with the what we call all the formats. And especially you need to focus upon all this particular in these two questions, question number 5 and 6. Is it clear to you? So shall meet you in the next session with something else. Hello and great welcome. So in this quick series, now we are picking up this particular chapter, that is cash flow statement. Surely you are going to have a question out of this particular chapter. Final accounts, cash flow statement, banking company, insurance company, electricity company, these are vital ones, no doubt about that. And the long question which you may have from final accounts and cash flow statements. Is it clear to you? This is important. So as far as cash flow statement is concerned, first of all, you need to know actually regarding cash equivalent. Is it clear to you? When we talk about cash, it means actually cash includes cash and demand deposits. And demand deposits is nothing but the amount which we have deposited in the bank, because at any point of time we can demand back our money. Is it clear to you? What do you mean by cash equivalent? Cash equivalent means such securities that is matured within a period of 90 days or 3 months. Suppose if I have got invested some amount, if I can get my money within next 90 days or 3 months, then such what we call securities are considered as equivalent, cash equivalents. Generally, short-term investment and marketable securities fall under this particular category. I need not require to tell you that CFS is prepared as per AS3 revised, wherein we are supposed to present the cash flow statement under 3 categories: cash generated from operating activity, investing activity, and financing activity. When I take my regular classes, I generally talk about this particular fact that when you compute your cash generated from operating activity, you take into account net profit. Then you add back all the non-cash items like goodwill written off, preliminary expense, discount allowed, underwriting commission. And in case if you have had transferred any amount to general reserve or reserve fund, even that amount will be added back. Then non-business financing expenditure like interest paid and premium on redemption will also be added back. Proposed dividend will also be added back. In case if we have received any what we call non-trading income like interest and dividend received, we are going to subtract the same. Then we are going to get profit from operation. And then we are going to make here adjustment for working capital items. For example, if current liability is increasing, I am going to add. If current liability is decreasing, I am going to subtract. But in case of current asset, if current assets are going to increase, then I am going to subtract the same. If current assets are decreasing, I am going to add back. I will get cash generated from operating activities before taxes. And finally, I am going to actually subtract the tax paid. Is it clear to you? This is what we had talked about in the classes. Now, coming over to some important aspect. In order to recap this particular chapter, the important thing is that first of all, you need to be quite well versed with all the treatment. I need not require to talk about, but still, just wait. For example, suppose you are given in the question, in the balance sheet only, that last year provision for tax is this much, in the current year it is this much. If it is given only in the balance sheet. So last year provision for tax you will consider as tax paid, and you are going to reflect, both these items will be reflected under cash generated from operating activity, but tax paid is subtracted at the last, and provision for tax you are going to add back to the net profit. Is it clear to you? Now, if provision for tax is given in under adjustment, for example, in the balance sheet provision for tax is given and then you have been given tax paid, obviously under such circumstances you are supposed to prepare the account. Opening and closing balance you are going to write, then you are going to write what we call provision for tax, which is given in the, tax paid is given in the question. So you are going to write here tax paid, and balancing figure will tell you how much provision you have made in the current year for the purpose of the taxation. Obviously, this tax paid, as you know, will be subtracted as the last item in the cash generated from operating activity, and provision for tax will have to be added back. Is it clear to you or not? Then in question number 1.3, if you remember, equity share capital 50 lakh is given last year, and in the current year it is given this much. Correct? Just wait. So equity share capital 50 lakh last year and 80 lakh in the current year is given to you. Besides that, property, plant and equipment is also given. I am not concerned with that. But at this moment, you pay attention towards this line. Below it is given directors declared and paid. Word paid is very important. Dividend at the rate of 10%. So directors in the current year have declared and paid a final dividend of 10%. If word paid is written, in that case, treatment of dividend will be done. First, you compute 10% of the opening equity share capital. That is 5 lakh. So that means we have paid a dividend of 10%, that is 5 lakh in the current year. So before paying the dividend, we must have extracted the amount out of profits. That is why I am going to write it under cash generated from operating activity 5 lakh. And because we have made a payment of dividend, it will also be written under financing activity. Is it clear to you? Now, here in 1.4, it is given that share capital is 1 lakh in the current year. Last year, it is 1,50,000. Again, here it is written declared and paid a final dividend of 10%. Declared and paid. So I am going to compute last year's equity share capital, which is 150. 10% I am going to compute. That will tell me the final dividend paid. It is also known as final dividend. Now, because final dividend has been paid, so treatment will be similar to the one as I told you. First of all, you are going to write here under cash generated from operating activity, and then you are also supposed to write it as negative item under financing activity. In this question, it is also given interim dividend paid during the year. Now, if interim dividend paid during the year is given, similar treatment. First, you will have to add it to cash generated from operating activity, and then you will take it to the what we call financing activity. Correct? In 1.5, it is important. Here it is equity share capital is given in the balance sheet, property, plant and equipment is given in the balance sheet, but below it is given director proposed 1 lakh dividend in the last year and 1,50,000 in the current year. Importantly, here word paid is not written. So under such circumstances, the dividend which you have proposed in the last year, quite obviously it must have been paid in the current year, because this dividend was proposed last year. So by the end of the current year, this dividend must have been paid. So because this dividend has been paid, you are going to first of all write it as, you are going to write here proposed dividend. Correct? 1 lakh rupees. And you have paid here, so you are going to do the treatment also. But no treatment will be done for this amount, 1,50,000. That means as per accounting standard AS4, you are not going to do any treatment of the dividend proposed unless it is paid. So because here word paid is not given, because whatever dividend which you have proposed in the current year is still not paid, so no treatment is needed. So treatment of 1 lakh will be needed because it must have been paid by the end of the current year. Is it clear to you? I'm sorry, actually I'm not well today, so that's the reason. I hope you got this particular point. Is it clear? Now similarly, coming over to 1.6. Now here, how shall you deal with the following items while preparing cash flow statement as per AS3 revised? Now here equity share capital 50 lakh, 60 lakh is given. Quite obviously, if equity share capital will increase, you are going to reflect it in your financing activity as issue of equity share capital, property, plant and equipment 15 to 27. That means purchase of property, plant and equipment, and you are going to reflect it what we call as investing item. Again here, dividend declared. Company declared a final dividend at the rate of 10%, but it is not paid, so no treatment will be done. I have written here, since dividend has been declared, under AS4 it is not a liability, so it will not be recorded in the financials. Is it clear to you? So unless dividend is paid, you are not going to make any treatment for the same. In 1.7, you can see you are being given fixed asset 5 lakh, 8 lakh. So some information is given, so you are supposed to prepare what we call an account. During the year, a part of the fixed asset 2 lakh, accumulated depreciation 1 lakh was sold for 80. So a part of fixed asset cost 2 lakh, accumulated depreciation subtract, you will get written down value, you will get, then it is given in the question that you sold it for 80, you will get a loss of 20,000. Further, it is written another part costing 50,000, accumulated depreciation provided 30,000 was scrapped. Another part. Now, another part was 50,000 cost, accumulated depreciation 30,000. So its written down value must be 20,000. It was scrapped, means you did not get anything against the sale of that particular asset. So there will be a loss of 20. So all in all, 2 lakh plus 50, 2 lakh 50,000 worth of fixed asset costings was out, and accumulated depreciation 1 lakh 30. So total written down value 120, total sale value is 80, and total loss is equal to 80. All you have to do is now to present this column in the account. First you write opening balance, closing balance. You sold the asset for 80,000, accumulated depreciation 1 lakh 30, and loss is equal to 40. So you write the loss. You will get obviously the total purchases. Is it clear to you? Total purchases will be reflected in investing activity, sale investing activity, accumulated depreciation. You are going to present under cash generated from operating activity, and loss will be added. Is it clear to you or not? Actually, I have turned on the AC also. You are having a cold also. So this is how you are supposed to do this particular question, correct? Then 1.8 is given. Under 1.8, you are being given plant and machinery 5 lakh, 8 lakh. So you will write 5 lakh and 8 lakh. Then it is being given 50,000 depreciation was charged on plant and machinery, but also it is given a piece of machinery was sold for 8,000 during the year. It had cost 12,000 and depreciation 7,000 had been provided. So first you take into account this information. Cost of the machinery 12,000, accumulated depreciation 7,000, written down value 5,000, sold for 8,000. So there is a profit of 3,000. So first you incorporate profit or loss, sale value and accumulated depreciation. So you are going to write you sold it, then depreciation, then profit you are going to write on the debit side. Now you take into account this depreciation. Total depreciation charged 50,000, but out of 50 you have already written 7,000. So you write here now 43,000. Now you balance it, you are going to get 3,55,000. Opening and closing balance will not be written or presented elsewhere. Profit will be subtracted from cash generated from operating activity. Sale value and purchase will fall under investing. Accumulated depreciation, you will take it to the cash generated from operating activity. And of course, depreciation also. Correct? So this is how you are supposed to do this one. Similarly, here it is given plant and machinery 5 lakh, you are going to write 5 lakh and 8 lakh. Accumulated depreciation given in the balance sheet. Whenever accumulated depreciation is given in the balance sheet, it means this value is at cost. And you are also being given net value. We are not concerned with the net value. First you write the opening balance, closing balance, then open accumulated depreciation, write opening balance, closing balance. Now take into account the following information. During the year, a part of machinery costing 3 lakh, accumulated depreciation 2 lakh, was disposed of for 1,75,000. So 3 lakh worth of asset has been sold. Correct? Accumulated depreciation 2 lakh. That means written down value 1 lakh and it has been sold for 175. So 75,000 is the profit. So first you write here cash sales 1,75,000, then accumulated depreciation 2 lakh, and then profit 75,000. Now you close this account. You will get a figure of 6 lakh. Now how to post? Opening closing balance will not be posted elsewhere. Profit will be subtracted from cash generated from operating activity. Then cash purchases and sales will fall under investing activity. But this time the accumulated depreciation will not be presented under cash generated from operating activity. The reason being is that because you are preparing accumulated depreciation. So you will take this figure here. That's all. Now this account is over. Now accumulated depreciation, opening balance, closing balance, and this amount you have written. Now you balance it. It will tell you how much amount you extracted out of profits in the current year to make a provision for depreciation. This amount will be added to cash generated from operating activity. Is it clear to you or not? Similarly, here in 1.10, you are being given fixed asset 140 and 170. And accumulated depreciation 40,500 and 24,000. Below, it is given that depreciation provided during the year. Word provided is of paramount importance because it is written depreciation provided. So don't do the mistake of writing it what we call on the credit side of the fixed asset. Instead, because it is given depreciation provided, that means how much depreciation you have provided in the current year, that is already given. 13,500. Now you first tally this one. This you will get this balancing figure. And this figure reflect that this much of depreciation has been charged. And now you transfer this figure over here. So this figure is already given. Opening closing balance will not be posted anywhere else. 13,500 will be taken to cash generated from operating activity. This figure is already posted here. Now you tally this account, you will get 60,000 as cash purchases. Is it clear to you or not? Now, in 1.11, you are being given fixed asset. But if you remember in the regular classes, I talked a lot about that. Fixed assets are written in the balance sheet 5,10,620. And in the additional information, you are being given provision for depreciation 150 for last year, and in the current year, it is 1,90,000. So whenever provision for depreciation, opening and closing balance is given in the adjustment, it automatically means that fixed assets which are given in the balance sheet are at a net figure. So that is why what you are going to do in this question, when you are going to write opening balance, you add the opening balance of what we call provision for depreciation to bring it to the cost. So your opening balance will be 6,60,000, and similarly closing balance 620. You write the what we call closing balance, add it. Now you will get 8 lakh. No further information is given. Directly you can get the purchases 150, and you write here opening balance of provision for depreciation. Provision for depreciation, accumulated depreciation are one and same, and this figure you are going to present in your cash generated from operating activity. Is it clear to you or not? In 1.3, actually here another question. Here it is given that investments are 1,80,000. So you write 1 lakh investment account, 80,000 closing balance. Capital reserve opening balance nil, closing balance 30,000. So you write here capital reserve account, opening balance is nil, but closing balance is 30,000. Now below it is given to you that during the year some investment were sold and profits credited to capital reserve. Indirectly, it means in the current year I have sold some investment. But for how much, I do not know. But it is stated that there was some profit. Because your capital reserve is increasing by 30,000 in the question, as you can see. Because opening balance was nil and closing balance is 30,000 in the balance sheet. So capital reserve is increasing by 30,000. And it is stated in the question that whatever profit which you earned, actually, you transferred it to capital reserve. That means you did not transfer it to profit or loss account. So first you write this information, investment account debit to capital reserve. Now post this one. In the capital reserve, you are going to write on the credit side, and in the investment, you are going to write on the debit side. Now you tally the investment account, you will get cash sales. It will be presented under investing activity. Capital reserve account will automatically get closed. Is it clear to you? That means only one information, 50,000 will be taken to the what we call investing activity. Now this time there is a profit on sale of investment, but don't commit the mistake of subtracting it from cash generated from operating activity, because this profit was not taken to the P&L. This profit has been taken to the what we call capital reserve. So that's the reason. Is it clear to you? Similarly, there is another question, 1.3. Investment are 48 and 58. So first you write the opening balances, 48 and 58,000. Then here it is given some investment were sold for rupees 30,000 at a profit of 25% on cost. That means in this particular question, you have been given that you sold the investment for 30,000 and you earned a profit of 25% on cost. Try to understand. So first of all, what you need to do, because rate of profit is given on cost, you convert this into what we call selling price. 25% profit on cost. Cost will be presumed as 100. 25 will be the profit. Selling price will be 125. 25 by 125. 1/5 is your profit. Is it clear to you? Now, because you are selling the investment for 30,000 and 1/5, that is 6,000 is the profit, that means 24,000 worth of investment were sold for 30,000. Is it clear to you or not? Or you can simply say that 30,000 is the selling price and 1/5 is the profit. That means 6,000 is your profit. So all you have to do is now is to prepare investment account. You write the opening balance 48, you write the closing balance 58, and you have computed the amount of profit 6,000. Is it clear to you or not? And it is given in the question that you sold the investment for 30,000. You also write it. Now you will get balancing figure as cash purchases. Opening balance and closing balance will not be posted anywhere else. But sale of investment, 30,000, and purchases will be taken to the investing activity, and profit will be subtracted from what we call cash generated from operating activity, because this time this profit hasn't been taken to the capital reserve. Indirectly, it means it is taken to P&L. Question number 1.14. Investment 1 lakh and 1 lakh 50. You write 1 lakh and 1 lakh 50. Below it is given during the year company received dividend. So first of all, you prepare a dividend received account and write over here by bank 12,000. Correct? In this particular question, you have written actually opening balance and bank and interest which you have received. In fact, dividend which you have received. Now question says that out of this dividend, 9,000 relates to pre-acquisition period and balance to post-acquisition period. Regarding this, you have to be careful. You have received bank account debit to dividend received. So that is why you have written here by bank. And now whatever dividend which you have received, question says that out of that pre-acquisition dividend is 9,000. So whatever pre-acquisition dividend which you have received is considered as a capital income, and that is why it is credited to investment account. And post-acquisition dividend must be 3,000, and that will be credited to profit and loss account. Now you post this one. So on the debit side of dividend received account, you are going to write to investment to P&L. And now because you are preparing investment account, you will write here investment also. Now you can tally this, you will get cash purchases, you will write it in the investing activity. Dividend received. Whatever dividend which you have received will always be written as under investing activity. Dividend received is always written under investing activity. Now here you have written investment, this is already posted to here, and this amount which you have written, you are going to subtract it from cash generated from operating activity. Is it clear to you or not? Now, under these questions, I talked about the fact in case if such things are given in the balance sheet, for example, preliminary expense 70, now it is 60, that means it is written off, you are going to add it to cash generated from operating activities. Similarly, goodwill. In case if goodwill will increase, you consider it as purchase of goodwill and write it under what we call investing activity. All these expenses will be considered as written off. Is it clear to you? So these are some vital questions which you must do. So it is important that these adjustments must be what we call very clear to you. After that, now which are the major questions which you are supposed to do? Honestly speaking, the rest of the things are simple, but there are some questions which need some elaboration, especially section 5 of this particular chapter. Section 5, correct? Section 5 of this particular chapter is very vital. Generally, such questions you may be asked in the examinations. Correct? For example, here it is written G9 Limited has provided you the following information. Prepare a statement of cash flow from operating activity by indirect method. 99.99% we follow indirect method only. Profit and loss account is given to you. This is profit and loss account given. And here you are being given operating profit before depreciation, then you are being given profit on sale of investment, then refund of tax, then insurance claim against major fire, then depreciation, patents written off, provision for tax, proposed dividend, transfer to general reserve, then net profit is also given. Question is simply asking you to prepare a statement of cash flow from operating activity. Correct? And there are some information related to what we call current asset and current liability. For example, sundry debtors are given, stock is given, prepaid expenses, marketable security, cash and bank balance, creditors, and provision for tax. This particular information is given to you. So, what you are supposed to do under here, see here. First of all, you take the net profit which is given to you. Look into the debit side. You have transferred some amount, to proposed dividend, then to provision for tax, then patents written off, then depreciation. On the credit side, we are being given that we have received a refund of tax, insurance claim, and there was profit on sale of investment. You subtract the same. You are going to get cash generated from working capital item. Then below a complete list is also given to you. Is it clear to you? So take into account the working capital component, increase in debtors, stock, prepaid expenses, creditors, you write them over here. Regarding tax paid, you have to be careful. Why you have to be careful regarding tax paid? Because in this particular question, you have been given provision for tax 1,18,000 and 1,25,000. Is it clear to you? You write the opening balance, you write the closing balance. Correct? In this question, there was refund of tax also. Refund of tax you have already subtracted here. You must not forget to write it on the debit side of the provision for tax. Because if you are getting some refund, it will reduce your tax payment. So that is why it will be written over here. Is it clear to you or not? Now this amount is also given in the question. Where it is given? In the profit and loss account, you are already given profit and loss account where you have written 1,25,000. So you cross it here also. So all these figures are now available with you. Opening balance, closing balance, amount transferred to P&L and refund of tax. You are going to get tax paid as the balancing figure. This tax paid will be subtracted from here. Importantly, in this question, there are marketable securities also, but don't touch that. Write in the note that marketable securities have been treated as cash equivalents. That's all. You need not require to treat it, but important to write a note. Is it clear to you? So this is how you are going to do this particular question. Such questions are in the examination generally asked. You are not going to be asked very straightforward question wherein you are supposed to prepare cash flow statement in a comprehensive manner. Rather, such questions are asked in the examination. For example, now here you have to pay attention. The following figures have been extracted from the books of Y Limited for the year ended 31st/3/2024. You are required to work out cash flow from operating activity. Generally, in the examination, such questions are being asked. Correct? Net profit before taking into account income tax. That means you haven't subtracted tax. But after taking into account the following item. But all these items have been adjusted. Is it clear to you? Further, it is given your net profit is 10 lakhs. Obviously, you will have to start with the net profit. It is given depreciation on fixed asset, you write here. Discount on issue of debenture, obviously discount on issue of debenture will be added back. Interest on debentures paid. Interest on debenture paid you are going to add. We are not supposed to prepare what we call complete cash flow statement. Correct? So interest on debenture will be added back here only. Otherwise, it is also written on the financing activity. Book value of investment 150 and sale of investment 160. That means 10,000 is profit. You are going to subtract the same. Interest received on investment, you are going to subtract the same. Then income tax paid during the year. Income tax paid during the year is 5,25,000. Now, income tax paid will be subtracted at the last. Is it clear to you or not? Income tax paid will be subtracted at the last. Important point is that you are not going to add here provision for tax. This 5,25,000 you should not add here. Reason? Because he has told that this net profit is before tax. That means you haven't subtracted the tax. So that is why don't add provision for tax here. And tax paid will be subtracted at the last. Is it clear to you? This is how you are going to compute what we call your cash generated from operating activity. Similarly, you are being given this information. See here. From the following summary of cash account, that means this is a sort of summary of cash account is given to you. This is your debit side and this is your credit side. And it is written Pharma Limited for the year. Calculate the cash flow from operating activities using the direct method. Using the direct method and prepare cash flow statement. Now, in order to do this particular question, because we are supposed to compute cash generated from operating activity and we are also supposed to prepare cash flow statement. Correct? So that is why I will write here financing activity. I will write here investing activity. I will also write, just wait. Sometime internet lagging takes place, it creates problem. Just wait for a while. Then I will write also cash generated from operating activity. Correct? We are being given opening balance and closing balance of cash. Obviously, we are going to treat it later on. We write opening balance and then closing balance. Cash sales is given to us. Now, if you remember, under direct method, I had talked about this particular fact. To compute cash generated from operating activity, we can use the direct method or indirect method. 99.99% we always use indirect method. In case if the question is specifically says that we are supposed to follow direct method, in that case, first of all, you write cash receipts, then write the cash sales. Is it clear to you? Then further in this particular question, it is given trade receivables. Now, trade receivables, that means we have received some amount from the trade debtors that is equal to 3,20,000. But important point is that you are supposed to present it here cash sales, then collection from debtors 3,20,000. Is it clear to you? Then we are being given interest and dividend received. Now, remember one thing, interest and dividend which you receive are not considered as part of operating activities. So that is why it cannot come here. Don't add it here. But whatever interest and dividend which you are supposed to receive, you will have to present it under investing activity. Bank loan you have paid. So bank loan will be presented under financing activity, repayment of bank loan. Sale of investment is 1,60,000. Obviously, sale of investment will fall under investing activity. Trade commission. Now, trade commission, word trade is already written, so it shows that it is a trading income. So, if it is a trading income, so it will be written over here under the cash receipts. Correct? So, this side is over. Now, we come over to the credit side. Cash purchases. Obviously, I will subtract cash payment and I will write cash purchases. Then trade payable, payment to trade payable will be written over here. Then we have paid rent and administrative expenses. It will be also written over here. After subtracting cash payments from cash receipts, we will get cash generated from operating activity before tax. That means when we use the direct method, we need not require to adjust working capital components here. Directly we can get cash generated from operating activity before tax. Now it is written income tax paid 60,000. Now you subtract 60,000, you will get cash generated from operating activity. Is it clear to you or not? Now, you are being given investment. You have purchased investment, so you are going to write it under investing activity. Repayment of loan will be written under financing activity. Interest on bank loan. You have paid interest. Interest on bank loan is not considered as part of operating activity. So interest on bank loan which you have paid will fall under what we call financing activity. Balance carried down you are going to write at the last. So this is how you are going to prepare this what we call a statement. This is how you are supposed to do these questions. Section 5 is very vital. You are bound to get questions only from this particular topic. Is it clear to you? One more, just to make the point more clear. Now here it is written cash flow from operating activity. Net profit is given. Items considered in determining the above net profit. That means all these items have been taken into account when you determine this profit. So first of all, obviously you are going to write net profit. Interest on long-term borrowing, because this interest has been taken into account. So that means when you computed this profit, you must have subtracted this item. So that is why it will be added back. Then interest on, then depreciation and amortization will be added back. Transfer to general reserve will be added back. Gain on sale of machinery will be subtracted. So after adding all these items, below you are being given some items of current asset and current liability, and then you write here working capital adjustments, correct? And then you get what we call cash generated from operating activity. Generally, such questions are being asked in the examinations. Is it clear to you or not? So this is with respect to your cash flow statement. On my side, I have tried my level best to take into account all the facets of cash generated from operating activity, but you need to stress hard upon what we call this particular area. Is it clear to you? So shall meet you with something else. Hello and great welcome. So coming over to the last part of this particular revision. And to be very honest with you, we have already comprehensively covered all the chapters, all the major chapters, all the important chapters, all the significant chapters. Isn't it or not? We have covered bonus issue, we have covered rights issue, we have covered redemption of preference share, we have covered also what we call buyback of shares, firm underwriting, financial statement, then banking company, insurance company, general insurance company, life insurance company, electricity companies, and besides that means all the major part is covered. Is it clear to you? The only thing is that regarding issue of share capital, what you are supposed to do. Under issue of share capital, because this chapter is known to everyone quite well, only the last section you need to stress upon. The questions related to forfeiture of shares, correct? Last section. So you do all the questions. And as far as redemption of debenture is concerned, under that, redemption of debentures. Under redemption of debenture, you stress upon conversion method. We have done lots of questions with respect to conversion method. And besides that, purchase in the open market. These are the two sections where you need to stress upon. Purchase in the open market. That is suffice from the examination point of view. Purchase in the open market. Is it clear to you or not? So that means as far as redemption of debenture is concerned, you need to actually stress upon conversion method and purchase in the open market, and issue of share capital is concerned, you need to stress upon the last section. Is it clear to you? Coming over to the Ind AS. Now, as far as Ind AS is concerned, to be very honest with you, what sort of question you may be asked? From this particular standard, you can be asked only what is the title. Under MCQ, you may be asked Ind AS1 deals with presentation of financial statement. Although we have done it at great length, but you need to know the title of this particular question, to be very honest with you. And at the same time, at least 2-3 differences between what we call Ind AS1 and AS1. This should be your focal area to cover this particular standard. Now, there are 3 Ind AS where you need to do it comprehensively. There is no question of what we call any revision. You have to do it comprehensively. Ind AS2, is it clear to you? That means you have to refer to the regular classes and go through the entire what we call chapter. We have done lots of what we call question with respect to this. So kindly do it comprehensively, because you are bound to get one question from this particular chapter. And at the same time, at least keep into account 2 differences. Is it clear to you? Coming over to events after reporting period, I don't think you will be asked any question from this particular part, to be very honest with you, but at least you should do difference. At least 2 differences you must know. Then coming over to employees, sure question from this particular standard. A sure question. From which section? Just pay attention. From this section, section 2, you are going to get a question. For example, case study 2.1, case study 2.2. That is more than sufficient. You need to require to waste your time. Is it clear to you? Now, coming over to earning per share, sure question. From here also, you are going to get the sure question. And you need to do it comprehensively. That means AS2 and Ind AS 33 must be done comprehensively. And especially the section which you need to actually stress upon will be the last section. Is it clear to you? The last section is very vital, but you have to do it comprehensively. 2 Ind AS you need to do comprehensively, Ind AS 2 and what we call this particular Ind AS. Is it clear to you? Coming over to the last section, Ind AS 37. Ind AS 37, it's a small one, no doubt about that. You can do it comprehensively, but to be very honest with you, generally you are asked differences. So at least 2-3 differences you should know. Difference between Ind AS 37 and Accounting Standard AS 29. So that will help you, what we call in recapping your entire course, and you can go in the examination with full confidence. But take my word, Ind AS 2 you must do comprehensively. Ind AS 2, Ind AS 19. Ind AS 19 I've already told you section 2, and Ind AS 33. These 2 Ind AS you must do comprehensively. From this particular Ind AS, from this particular Ind AS, and from this one you are bound to get what we call a practical question. Ind AS 33 and Ind AS 2 you must do comprehensively. Ind AS 19 I've already told you section 2 you must do comprehensively. 2 questions are there. That is more than suffice. Is it clear to you? This way around you can completely cover your entire corporate accounting course. I hope that all these revisionary series which we have taken will hold you in a very good state, and I'm sure that you must feel a vivid, what we call more confident, because now your worries must have been erased out of a bit. So sure to have your what we call feedbacks, and looking forward to meet you in final level. So with all the wishes and with best of luck, and of course we pray to the Almighty that each one of you come out with flying colors. So it's time to say goodbye, and thank you very much for giving us your company, and at the same time going through these sessions quite well, I'm very sure. So shall meet you, as I told you, at final level. So till then it's time to say goodbye and God bless you.